certainly looking for sources of revenue, and there is hope that the capital markets will provide that source of financing to move the Ugandan economy along. Without taking further time, I'm going to invite Alan Lutave from the CFA Society to make the opening remarks and start us off this very interesting journey. I'd like to recognize the presence of Keith Kalyagira from the Capital Markets Authority, who will be making some key remarks not so far from now. So, Alan, welcome. Round of applause for Alan as he takes the stage.
Good morning. Good morning, everyone. Some energy. People haven't had their morning coffee. Or are people still complaining about potholes? I'm delighted to welcome all of you to the inaugural Alternative Investment Conference, which is timely. If anybody has driven on the roundabout today, you would have noticed that we need to be discussing more how to fund our roads. Instead of just taking pictures of the potholes, I think there are also discussions on how we are going to fund that. And today's conversation is really around helping us formulate and understand the challenges, but also see the opportunities that are evolving in front of us. And so I'm very delighted that this notion or this concept has come to pass, and today we are going to be listening to a stellar cast of speakers telling us what they are doing in their different spaces to build a vibrant ecosystem to finance things beyond bonds and beyond listed stocks. Infrastructure, startups, ventures, all these need money, but we need to be discussing how to build a good ecosystem. So I'm very delighted that we are having this conversation today. This particular conference came from a conversation that I had with a couple of friends. I was with David and Doris about 6 months ago, and we were discussing what is missing. And in the conversation, one of the things that we realized that we need to build a conversation amongst participants and professionals. And that's catalyzed the viewpoint that we need to have this conference, and I'm delighted that in 2023 this is coming to pass. So as we have this 2-day session, I know you're going to be listening to a number of conversations, but take a minute to just reflect on what that means for you as an individual, but also what it means at a macro, at a national level, because the conversations we are having today are going to be forming the businesses, the jobs. They are going to be forming the economy of tomorrow. And I wanted to share those perspectives with you, such that over the next 2 years, you all get inspired as I was 6 months ago in terms of looking at alternative investments as a key thing. Now, as we move into our conference, we shall be listening to different professionals. Some are in the industry, venture capitalists, private equity, some are policy makers, others are participating in technology innovations. We have people doing very amazing things. But one of the things I had realized over the last 6 months is that a lot of this is not known. People don't know that these things are happening in Uganda. And I felt that it was important for this 2-day conference to highlight how Uganda could be different, what else we can do, and how individually but also at corporate we can catalyze the change we are crying for. So I'm looking forward to the conversations we shall have over the next 2 days, and I'm looking forward to hearing from you whether we have hit the mark with this conference. The key thing after 2 days, what I want to understand from the audience is, should we do this again next year? Take time, pay attention, and give us feedback at the end of the 2 days. We are always open to suggestions, and we are looking forward to very lively discussions today. Once again, welcome. This is the CFA Society East Africa, collaborating with IAVCA, the East Africa Venture Capital Association. We are also collaborating with CMA, the Capital Markets Authority. We are also collaborating with FITSPA. Those have been major players in helping us put together this conference, and we are delighted that most of them are in this room to also hear and listen to other players in the industry. To really take us forward, we shall be having some opening remarks from our key sponsor. The Capital Markets Authority has been working with the CFA Society East Africa from the very beginning. The society started in 2014, and at the time we had no offices, we had no officer, we had no establishment in Uganda, but the Capital Markets Authority really put a lot of emphasis supporting us, and today, 10 years later, 9-10 years later, we are seeing what the CFA Society is capable of doing. We are able to bring many videos to have important conversation. And I believe that was the vision that the CEO of CMA saw that the CFA Society can deliver. And so we are very delighted to have them. May I ask that you give them a big round of applause. They have nurtured us, they have supported us in different efforts, and this is still one of them where they have really pushed us to bring and broaden the conversation that we're having in the industry. I don't know if I should take the opportunity, Mr. MC, to invite our next speaker, but if that's not the case, I'll still use this opportunity to celebrate the Capital Markets Authority. The CEO is in the room, the director is in the room. They have been very instrumental in getting us to start thinking broadly. And I know along the 2 days they will be more impressed with how far we have come over the last 10 years in trying to put capital markets center in the conversation around building a better Uganda. Thank you very much for listening to me, and I look forward to hearing from you. Give us your feedback. We would like to hear how well have we done in preparing this. Where can we improve? Please send us that feedback to us, and we look forward to you enjoying the next 2 days. Stay with us. You will not be disappointed. Thank you very much.
Thank you very much, Alan. A stronger round of applause for Alan, please. Much better. There's a couple of things Alan mentioned that got me thinking. Spoke about the changes in the economy, and I was reading a report by Bank of Uganda about how the Ugandan economy had taken long to transform. And I think we're waiting for the capital markets to catalyze that change. So we'll be looking to you to, create that change. We expect the PSS we expect the PSSC to join us, and it's at that time that we will ask Keith to make his remarks. Otherwise, there was one other thing I picked up from what Alan said. He said, people do not know. And I thought to myself, there's a lot that we in this room do not know about what people in the industry are doing. So there is so much going on. You might be aware that collective investment schemes are now worth about 1.4 trillion. Assets under management. Dixon Sembuya, the director of market development and research at the Capital Markets Authority, will probably have the best figure, but it's about that much or more. Oh, it's 1.75. That's amazing work. Kudos to TMA and the players in the sector for that astronomical growth. We are ready to get into our first panel discussion. I'm going to ask Lisa to guide us All right. Yes, Lisa, what are your thoughts about the growth in the sector? We've just had an interesting figure. I think 3 years ago, we had about 700 billion in assets under management for collective investment schemes. It's now, that was maybe 3 years ago, 2020. Yeah. Oh. 2 years ago. 2 years ago, we had 700 billion in assets under management, collective investment schemes. The figure is now 1.75 trillion, which is, I don't know who's quick enough with the figures. Can you compute the compound growth annual rate for that? How much is that? 77%. Wow, that's huge. Lisa, your thoughts?
Good morning, ladies and gentlemen. Good morning, ladies and gentlemen. We've now had the opportunity to have a cup of tea. So it is our expectation as the organizers and the MCs that we'll have a very interactive session, and we are definitely available for anything that you may need to make sure that you're very comfortable during the 2 days of the conference. So globally, just to start off with a little bit of statistics, it has been estimated that allocation to the alternatives investment space has more than tripled over the last decade. People talk of 13 trillion, some say 16 trillion as of last year, and this is expected to double by 2026. Interesting is that we also see that private investors have become very interested in the space. So in the research, they have actually been able to pin down that out of every 10 person interviewed, for example, you realize that 4 out of 10 committed to having allocated a bigger share of their wealth to the alternative investment securities or assets, for example. We are also seeing this mirror on the institutional investor side. Globally, this is from allocations of, say, 17% to 30 or more percent. This is something that we've seen over the past decade within the pension space, insurance, and wealth, sovereign wealth institutions. In Uganda, though, if you look at the last 7 years, allocations in private equity, just to focus a little bit on private equity, we realize we've had an allocation in private equity kind of stable at about 1.5 or 2%, largely contributed by the NSSF. And if you look deeply, you realize that the last investment in the private equity space has been probably in the last 7 years or 8 years ago. So in the first session, it is my privilege, therefore, to invite Mr. Alan Wetabe. Alan is the Director Investments at the Deposit Protection Fund. David Wangolo, Investment Director, Pearl Capital Partners. Pearl Capital Partners invest in SMEs and focuses in the agribusiness sector. I would also take this opportunity to invite Carol Birungi, the Country Manager of XSML. You are very most welcome. During this session, we want to focus on the growth trajectory of private equity. You may take your seats. Thank you. So in this session, our session 1, we want to kick-start off with very high energies, and we want to speak about the categorization or the asset class that we are most focused on, especially on the institutional investor side, and that is private equity. And the moderator of the session will be Alan Wetabe to take us through the past, the present, and future prospects in terms of growth trajectory in the private equity space. Ladies and gentlemen, my name is Lisa Betty Oyela. I am the portfolio manager at the Deposit Protection Fund of Uganda. A little later we'll talk about what the DPF does, and then maybe you probably clearly understand what the investment department of DPF is responsible for. Prior to the DPF, I used to work at Uganda Retirement Benefits Regulatory Authority, still in the investment department. Join me in welcoming Alan, who will be the moderator of this session. Ladies and gentlemen, thank you so much.
Thank you, Lisa. Good morning once again. Welcome to our fireside chat, where we are looking at the evolution of private equity. We are looking at how the trajectory of PE over the last 10 years, the past, present, and future, try to connect where is Uganda coming from in terms of one of the key assets within all the key categories within alternative investments that is becoming more familiar to many of us. Where has it been over the last 15 years? Where is it today? And where do we see it going forward? And we put together this conversation just to translate the conversation we had 6 months ago, and we wanted to bring this forward to share our thoughts on what we see and why we think such a conference is necessary. And to join me to expand on this conversation, I have my good friend David Wangolo, who has been introduced as an investment director at Pearl Capital Partners, as well as my new friend Caro Virungi, who is at Excess ML Capital, who are also very good friends of the society, but also very key members within the industry. I'm going to pass it on to David, maybe to start sharing his mind on what he sees in terms of fundraising, and then we can take the conversation from there.
Thanks, Alan. Interesting introduction to private equity, and good morning to you all. It's fantastic to be in this room to discuss with you, our personal experiences in private equity over the last 15 years, because that's when we started tracking data in this industry. 2005, beyond that, before that, we probably didn't have anything that was ongoing. And now we are starting to see a bit more structured approach to the industry. Now, just reflecting on fundraising and where we are over the last 15 years, Africa as a region attracts about 5 billion in private equity annually for investment. East Africa as a region attracts 500 of that, and Uganda only takes about, on average now to date, or over the last 5 years of tracking that data, Uganda now takes about 20-25% of that, which is 100 to 125 million that comes in annually for investment. So that is an interesting number. It goes to show you that from 2005, where we had nothing, to date, Uganda has made quite tremendous progress in creating an asset class that can now be properly ring-fenced and clearly earmarked for how it's progressing. Interestingly, just to give you another statistic, as of June 2022, Uganda had cumulatively made investments of up to 1.4 billion US dollars in private equity deals. And that's from 2005 there. That represents about 80 million US dollars annually. Now that figure has gone up a bit, from 80 million average through that period of time to 120 million on average to date. So those are indicative statistics of how big this industry is and how much traction it can gain in so little time. So is this the right time, therefore, to have this conference, and is this the right time for us to have these discussions? Yes, because there is clearly sufficient amount of capital that is available for investment. Yes, it's going to specific sectors that are driven by financial services, agribusiness, manufacturing, telecommunications. Those have been the attractive sectors. But, with the energy and oil and gas sectors, which are, lead large sectors, there will be catalytic effects felt in the private equity space for manufacturing agribusiness going forward. Some of those investments have been made over the last so many years. And just to take back the discussion to Alan, what has been the composition of those investors? Who are those people bringing in the 120 million annually? We have been mainly anchored by DFIs and foundations and endowments. There has been very little or no participation from a local investment class, which has very dire consequences for how we develop and grow this sector going forward. And it is something I always pinch Alan about. What are we doing with the pensions? What are we doing with the insurance? And where are those challenges? And where do we see them going?
And I mean, what is very surprising is that most of the funding that is coming in is from pension funds in other countries providing funding for Ugandan businesses. But what we don't see are local pension funds funding Ugandan businesses. And it begs the question, why is it that a pension fund in Norway feels so confident to invest in a business, to invest in Bujagali in Uganda, and they have never been there, but NSSF cannot get or participate in a deal to build a dam in Fort Portal? And it's always bothered me a bit, and it has catalyzed my thinking along the way that perhaps we need to have awareness, literacy about these things, and this is where this conference is coming on for me. But what is very dismal is NSSF has tried in the past. I think they have participated with the yield fund, which you manage. But if you look at the total composition of investment from local pension provident funds in this alternative space, it is below, I think, 1% allocation in total. And if we are to build a more tractionable space where we are able to cheaply fund local ideas, innovation, and ventures, it's important that then we have an understanding about the cost of money, whether we borrow from in a foreign currency perspective or we focus on borrowing from a local currency perspective. It may be cheaper for us to build businesses using Ugandan funds than to build Ugandan businesses using foreign funds. And this is some of the things that we need to be expanding, working, of course, with the regulators, both CMA and UBRA, trying to see that we bring at least, even if we bring in an allocation of up to 5% to 10%, we are talking about $50 million to about $100 million. If we can bring in that money from pension funds, local pension funds, it can have a significant impact in the space. But perhaps Carol may have some thoughts. What have you seen on your side? I know you participated or you led the transaction to set up Medical Hub. How did you do that? Where did the funding come from? What challenges, what can you offer at terms of thoughts?
All right. Thank you, Alan, for the question. Yeah. So what we've seen in this space, and I'll talk to what we've done as XSML, because I think that what we've done and how we do it is the best way we think such a structure or PE funds can thrive, as well as the market. So most of our funding, and it also goes through the Medical Hub, the question that you asked is as mezzanine debt and then quasi-equity. But what we've seen and why we think that debt or mezzanine debt works best in our market is because as an economy or as a country, we do not have good appreciation of how equity works. Entrepreneurs don't know what it means to have a shareholder come in, they want ownership of the company, and that's why we mostly go onto the debt side. Even when we are structuring the Medical Hub or a lot of our investments, we've gone through debt, and we do a blend of equity once in a while. Sometimes we take on maybe revenue share and a few other instruments in the way we structure these deals. But it's mostly because this is more flexible. The entrepreneurs understand this better, the market understands this better. But then also with our investors, most of our investors are institutional investors. None of them are Ugandans. even with our fewer investments in Uganda, none of them are Ugandans. These are mostly DFIs, but from Europe and other Eastern countries. But also to get return to give back to these investors, so that next time when we go back for money to invest in our markets, they're willing to extend that capital. So most of the challenges we have is explaining to these promoters or the entrepreneurs that yes, we are investing in your company. We do not want ownership, because that then is another discussion. But the challenge is explaining to them that this is how I want to invest in your company. I'm helping you grow this company, and of course I would want a return. But both of us are in this together. We're partners. We are building a long-lasting relationship. So it's something that goes a long way, and I think the association or other private equity firms, they could maybe speak more to this, but it's an education for the entrepreneurs to understand that this is our market. I'm investing in you as XSNL or the fund that I manage that has money from outside investors, but I'm in this with you, and I want you to grow. I want to build a long-lasting relationship. And also that is the other reason why we invest as debt or mezzanine debt, because with equity you're in, you have 2-5 years you're out. But then with the way that these deals are structured for us is that you have a fund, you're investing in this entrepreneur for maybe 5-7 years, and then because these are growing enterprises, these are growing businesses, after the 5-7 years they've grown, they need more capital. Yeah? And that is not very common in our market to get such capital for more than 7 or 10 years. But because I'm raising funds, and I'm raising funds all the time, it is very easy for me to go back then. After these 7 years, I can still go back to the new fund. And this is a relationship. This is something that is very, very important in our market, so that we are not investing to get out. We are investing to stay, but also to live viable businesses, and viable businesses for our local entrepreneurs. Because most of these businesses, our sector is not so big. We don't have very many sectors. The market is a bit small. So we are not sector-centered, or we are not concentrated in a specific sector. We invest in all sectors, and I think it's the same thing for most of the private equity companies in Uganda. That's the past, the present, and the future is that private equity, we should look at it in a way that it's supposed to have sustainability capital. We should give sustainable capital to companies. We should tackle what is most need, what is the need for the economy. We shouldn't come in with our own strategies, but what works for this economy. If venture capital doesn't work, what works? Is it early stage capital? Is it equity? Is it straight debt? Is it mezzanine or blended equity? And for the future, or for us to thrive in this market, I think we need to understand what fits in well. Most of our big companies are family companies, mostly owned by Ugandans or even foreigners, but most of them are family companies. So what works best for such companies? Yeah, so in terms of structures, I think that is key, and strategies. For sizes, what I've seen, or what we've seen in the market is that we are all over the place. We invest in small, big, medium companies, and I think this works for us. This works for our economy, because we have all kinds of companies. We have the growing, we have the grown, and the mature businesses, but this is what we've seen in the past. No one wants to touch the really small ones because there are too many issues. No one wants to touch the big ones like Ugandan, because again, there's a lot there. But then my question to you, David, is then how do we get the middle ground for such structures and the way we are set up as a private equity market?
Yeah, thanks, Carol, for unpacking some of those issues, and I'd like to reflect on them in the sense that we structure private equity in this market as debt or as mezzanine, to facilitate exit, and also for efficiencies in terms of taxes. When we look at capital gains on the equity side of things, people are better off paying the withholding tax rather than paying capital gains tax plus withholding tax. So those are serious regulatory issues that need to be dealt with in government, to eliminate or take it to zero for private equity to attract zero capital gains tax, and even zero withholding tax. After all, that business would have been set up and it's employing and paying taxes. So that's a structural issue with the market, and therefore when foreign investors come in, they're looking for the safest way to exit from a regulatory point of view and also from asset risk management point of view. I mean, as you say, they're investing in family-owned enterprises. So how do you start running business at a kitchen table from Europe? So that becomes a big constraint to how you influence governance and manage those kind of structures. So then it means that really you have to go for the mezz or debt-like structure. But it would be interesting that we develop opportunities for pure equity, long-term investment kind of structures, so that the capital can sit in a bit longer, the relationships and governance can be built, and we can leverage on that plus by attracting more capital. So that's a structural issue, and then also a traditional issue of the type of businessman that Uganda knows. And I sympathize with you, and I sympathize with my colleagues as well that I work with. The challenges we go through in terms of active management and thinking we can make changes in these companies over a 5-year period. It's impossible to change a man who has built a business from his kitchen to the dining table, now to the sitting room over the last 20 years, to change that man into a boardroom type guy, in 5 years. So there are constraints there on timing. And also, without local capital, as Alan alludes, and I always point to Alan because he's the pension man here, without you encouraging those guys to come to our side, then it's going to be very difficult to change that ecosystem. So you maybe would want to respond to the issues around structuring there.
I'm going to just throw the spanner in the works here a little bit. You are using a lot of terminology, mezzanine debt, all this terminology, your industry is terminology heavy. And a lot of the people that are in the pension space may not be as well versed with so many of these things. How do we unpack PE? Perhaps do we need private equity literacy? Is it something that we should spend time on to make Luganda words of mezzanine debt? Is it something that we need to approach and unpack some of these very complicated stuff? On the lighter side, what are your thoughts there? Because I know it's easy for us here to throw around some of these terms, and it makes sense to us. But to a person who is new to the space, they may want to wrap their minds around what do we mean by an exit, what do we mean by mezzanine debt, quasi-equity, what is all this stuff? Perhaps we can also spend a minute or two on just unpacking some of the things for Muntu Awansi.
Yeah, excellent. You get me on that. I think the issue is not unpacking these words, quasi, whatever, mezzanine, and those things. Those are not the things that build business. Those are not the things that build private equity. The real thing that will build private equity is governance. If people can trust, respect governance, trust and respect professionals, invite professionals into the room, allow the professionals do their work, whether it's the lawyers, whether it's the investment advisors, and allow the promoters to also do their work, run the vision, but guided by governance. Quasi, mezz, equity, debt means nothing when all that is in place, because the structuring will only advise on risk, which is a very small component of the entire package. The bigger package to me, and my colleague here, Carol can attest to that, is really what is governing our relationship. And if that is not clear, then we shall remain, peanut businesses, wherever we started them from, and they will not grow out of those ecosystems. And maybe let me now at least throw this back to Carol. Given the short time frames and the evolution, short time frames in terms of managing these businesses and developing a governance culture and trying to drive them to exit. Just just share with us your personal experiences around that. Portfolio management. What are the higgy huggers there? Where is the pull and push that happens there? Thank you.
David, you need to stop using big words. Yeah. Right. So just to unpack David's big portfolio management one, this is really the relationship between the funder and the funded. Yeah? Back in the day, people used to think, or investors used to think they would just fly in once a month or once a quarter just to come and check on their investees. But we've seen that it doesn't work. It doesn't work that way because the biggest challenge we have in our market is transparency and trust. Yeah? So you find this promoter, this entrepreneur, they started their business maybe very many years ago. You came in, you invested, they're now somewhere, but maybe somewhere along the way they didn't use all the money you gave them to do what they had to do. It's very easy for them to put up a show during that one time you come, and you wouldn't get the actual picture. So the main thing with portfolio management is relationship building. Do you have a relationship with a promoter? Do you have a relationship with this client? David rightly mentioned that our biggest problem is governance. And again, a big word, but our entrepreneurs don't see it as a big problem, though it is a big problem. I'll just introduce one section of governance that our entrepreneurs don't see as big. Okay, they've now started, some are starting, is the CFO role. Many of our entrepreneurs or many of the businessmen we have around is they think they will get a family member, a friend, come and do their finances. But then one thing that is very important with private equity from the investee is their financial statements. Are they in order? Because then how is the external investor going to know that, yeah, this is actually a healthy business and I can actually invest in it? So that is something we need to get the market to understand. For us as XSMO who invest in SMEs, that is now a very big problem and challenge because they think if it's a factory, they will manufacture and sell and they'll have their profits. But if you sit down with this person and ask them, okay, take me through what are your lines, what are your sales, what is your cost of sales, what are your expenses? They don't know what is your bottom line. They have something that they've bought from their people, but are they the right people in those positions? And you cannot know until you have that relationship with this company, with this entrepreneur. Most of the DFIs or most of the private equity firms have brought in something we're calling technical assistance or BDS support. Business development support, yeah. So they've brought in something like that, but also that can't work if there's no relationship because they're going to invest in something that they don't need. They need an accounting system. They're going to come and invest in what? Yeah, cameras. Yeah, so it won't help. So until you have this relationship and you're doing this portfolio management, because most of our entrepreneurs need hand-holding. We need to appreciate that. And that's the truth, that's the fact. And so we need to act on that. If we get our TA support or BDS support, where does it go? We have ESG issues emerging. Again, environmental, social, and governance issues emerging. But if we don't understand what exactly they need out of this entire ESG package, we are going to go and throw money at them, and they're going to use that money for something else. So yeah, so ESG is emerging. It's very important for our DFIs, for our investors, and it's something very important. We've realized after going in that, yeah, it looks like a term or a big word, but they need it for them to progress. If you're a manufacturing business and you're not ISO certified, you won't get big clients because that is one of the things they'll have to tick off. And if you do not know that these people don't have it, because when you're doing your due diligence, those are some of the things you miss out because you think it's not important. But they're missing out on business because of something that simple. So this relationship helps you get to understand what do they need, what is their need, how can I help them. We should appreciate that if you're giving an entrepreneur money this year, in most cases after 2 years they'll come back for more money. And maybe they'll have the right reason, or maybe they won't. So with this relationship you can advise them and lead them to the right, to the right path. But then one important thing that I would like my fellow panelists to weigh in on is ESG, because it is something that maybe we do not understand, though very easy to understand and very important. And so I will ask Alan to just expound on how do you see ESG affecting us as investors or as PE funds, but also the market, the SMEs, but also the non-SMEs, because we also have a lot of those that are overlooking that. And just for you to expound what we need to do.
Thanks, Carol, for that exposition. Of course, we are seeing ESG becoming a major factor in terms of the criteria which global funders are looking for. There is also interest in ensuring businesses are well mapped to the UN SDGs. I run a startup accelerator, and one of the things that we do when we are looking at new businesses or new ideas is that your idea must solve a community problem as mapped out by the UN SDGs. So you must clearly demonstrate, are you creating good jobs? Are you able to improve the environment? Are you able to tap into improving water sources? Are you cleaning up plastic within your business model? Because now where we are moving to, everybody is becoming cautious that the best way to influence communities is through capital. It is only when capital is coming in that certain questions can be asked and certain requirements can be put into being. And so we are seeing that a lot of the new money that's coming in, impact investing, is where the focus is. And for Uganda, that is becoming more prevalent. Of course, Uganda is an agricultural-driven country. And so we are also seeing a lot of interest in funding that is tailored towards solving solutions in climate, agriculture, and environment. Again, even for other businesses that are not typically within that space, we are also seeing them being forced to highlight how they are helping in their little way. Even if you are doing a fintech, there is now a view that within your fintech, you should be able to clearly demonstrate how you are helping the environment, climate, job creation, women empowerment, all managing older persons. There are all these conversations that are part of the ESG story. ESG is very diverse, and I think we lose it when we focus on the three letters, environment, social, and governance. But there is a lot more when we start to unpack and look at the criteria. We have Bloomberg and Reuters, they have developed very detailed measures that companies can use to track how best they are meeting these requirements. That's becoming very important. We are seeing that there are more flows now being channeled towards companies that are able to demonstrate clearly that they have ESG as part of their business model, and they're able to clearly measure that and report on that in their integrated financial reports. So it's a key thing. But in terms of, if we look on the other side, for local investors, are they interested? Are they tickled by ESG? I believe from my previous job in the central bank, my current job in DPF, I've not seen a lot of interest from local investors, local institutional investors, asking questions around ESG. There are some conversations we see here and there. The central bank has issued some guidance to commercial banks and other licensed financial institutions on what they need to be thinking about around ESG. But we are yet to see, from an investment perspective, a key requirement that institutional investors, pension funds, insurance funds in Uganda should take this into consideration seriously in terms of their criteria. That has not happened yet, but I believe that it's a natural evolution. As we learn from other bigger investors, then we'll be able then to bring about the green initiatives, smart initiative, climate-aware initiatives, and bring that as part of our investing. But of course, the other challenge I have, and this may be for David, is that for most of the pension funds, when they are looking at investing away from fixed income, they will compare any new investment against a 5-year, 10-year bond. So you are looking at 15%, 16% expected return annually. Is it something that private equity VC can offer? How best do we align and give them comfort that the return they are likely to generate is well aligned with how they compare? And of course, the other challenge that I have with pension funds is that their need for liquidity is very high. Most of the more mature pension funds are having retired persons exiting, and so they do need some outflows here and there. So committing long-term 15 years, 10 years, without any intermittent liquidity, without money coming in year 1, 2, and 3, becomes very difficult. So if we marry these two challenges, they compare any new investment against bonds, and they also they have a higher desire for liquidity. How have you addressed these? Have you seen this as a challenge, an opportunity on your side? Has it been solved elsewhere and we can just borrow and cut and paste? What do you think?
Yeah? Okay.
Yeah, just to start off on that, and then I'll hand it over to you. So for private equity, like I had mentioned at the start, is for companies like XSML that don't really, though we are in the space of private equity, we do not really so much invest in pure equity. So one of the solutions is what we do for pension funds, because with a structure like MES or quasi-equity, you still have some cash coming back to the pension fund or to the investors, even in year one, if investments have been, if the investments are good. So that could be one of the solutions or the future for local pension funds as a solution to not to compare this to bonds, because there's an option this to get to the liquidity that you need on an annual basis or even a quarterly basis. So it's possible. So that shouldn't be a reason.
So I think maybe the follow-up question would be, have you tried to invite pension funds to participate alongside your companies? Maybe that will be a rejoinder that will be helpful for us to appreciate.
Okay. Yeah. So we've actually invited some of them. We are yet to meet some of them, but right now I'm inviting you.
We can try to be very prescriptive with private equity, but it's impossible because there are so many stages through the journey of private equity. Yeah. Right from investor mandate to investment portfolio management to exit. In terms of exit, if I just describe the structure of exit in the East Africa region over the last 5 years, sponsor exits have led where another fund comes and buys the stake. Okay, and it's a bigger fund. It's a rejoinder on the small ticket, and then there is expansion in that company, which is a plus and enables the earlier investors to find an exit. The other two attractive exits have been strategic purchases, where we have some big corporates looking for strategic entry, which is an emerging theme for East Africa. For example, we've had a lot of interest in companies trying to set foot in Uganda, and the only way to do it is to buy. A case in point is one of the businesses we worked with, Binsika Poultry International, which is one of the clear examples of strategic entry of potential partners. And the other is sell back to the owners. So that is where the mezzanine of finding self-liquidating instruments that enable the owners to take back the business or buy it back. Those tend to share about 25% of the exits. With the IPO being the least, pension like to listen to the most regulated area. Now, when we tell them that the structure of exit is sponsor, 50%, 25% is a strategic buy. 25% is buyback by owner, which is a structuring. IPO has 1%. Okay, they say 3, but me, I think it's not there. That is a real issue, but they want to hear it. Why do they want to hear it? Because there is a regulated market in the IPO market where they believe their return is guaranteed or secure, or they can actually get it. But that is not the exit for PE. So this is a real education point that we need to make sure that as we educate the pension on exit, on return, right? They want their return. The issue is that the exit route is like that. And therefore they must, and in their investment policy statement, understand that they must design their, annual emoluments as they go out or come in, that will be the what? The cycle. Because if they don't build it in their statement, then we are going to have quack investment managers here promising things, Ponzi schemes to manage private equity, which is not possible. That would be my submission.
All right, thank you, David. Before we wrap up, we need to make Keith very comfortable that in the next 10 years or the next 5, there must be IPOs coming from private to public. Could you just paint a picture? Is it something that you see in your portfolios? Are we likely to see some Ugandan companies listing on the Uganda Stock Exchange in 5 years? Coming from the private space, coming from fundraising where you are, where you have invested, built up a hospital for Carol, you have put up some agriculture companies, you have invested them, they have matured. Are they ready to list such that my people in the pension space are more comfortable to see them? But also Keith then will be happier. But then the journey from 0 to 100 is very, very clear. Just in about a minute or two, can you share what is the picture like in terms of that? Are we likely to see more IPOs? Are we likely to see more public listing of Ugandan companies that are coming from private to public?
I think the real journey, now we have done 15 years, possibly, of recorded data. Now we need another 15. In those 15, we are going to see strategic acquisition, I think, take a more bigger picture. So we need to see consolidation. So from growth, or early stage to growth, then growth to consolidation. If we have that, then you have companies that are listable on the exchange. So we did another 15 years of consolidating all the players, say in poultry, and just bring them all together under one umbrella and calling that the Uganda Universal Poultry Company, and now listing that. Yeah, that is the stage. I don't think we have gone, we are just starting the consolidation phase where we are dropping off the bad players and consolidating the bigger ones. Now, when we consolidate that, then we'll have players with a regional presence, with near monopoly-like. I like monopolies. Near monopoly-like, because they are price efficient. They set better prices, it is. Then those can list, and then now we can, have Keith's glory and the pension glory through the IPO. But before that, I really fear for where we are in terms of the IPO private-public.
So before Carol comes in, you mentioned the key point there about building monopolies. And I remember a research by Dr. Rishi Ganti who speaks about historic assets. And one of the things that he raised was that we are taught in school, Economics 101, that monopolies make good profits, supernormal profits, and competition kills profits. But later in life, we undo all the economics we learned, and we focus on forcing everybody to enter into competition, knowing that competition kills profits. And I like their submission that we actually should be focusing on building monopolies, especially if we're building companies, because a company to go IPO has to be a giant, has to have the potential to take over, to build market share and become very important in the space, wherever they are. And so it's also important to remember Economics 101, that price competitiveness is bad and monopoly is good, I think from an investment perspective. So I wanted to just throw in some onions in your submission. Carol, you want to share some thoughts?
Yeah, but it's just to add to what David said. I think, corporate mergers and acquisitions, and mostly mergers is the way to get to what Keith would want, because yes, we all know that our companies are still so young for that. But then also the other thing that I wanted to point out was maybe movement towards alliances, private equity alliances with pension funds, or even DFIs that are doing direct investments. So instead of the DFI investing in a PE fund or fund manager, then why not, yes, invest in the fund manager and then create an alliance, go in, put in more money, because we all know that we have ticket sizes. So maybe for this company to grow to a level at which it can go into an IPO, it needs more money that you can provide as a PE fund. But if you have such alliances, then maybe it will speed up this process, and maybe the 15 will be cut into half. Yeah.
So just to wrap up, David, Carol, are you fundraising in the next 6 months? What are your figures? What are you looking at? Maybe to give comfort to the audience that you are a going concern.
Of course, we are always a going concern. But yeah, to answer your question, yes, we are fundraising. We are fundraising for our 4th fund, African Rivers Fund 4. Our targeted close is end of this year. And we invite you. We invite you, Alan. We invite you, Keith. And yeah.
How much?
This would be a $150 million fund. Yeah.
Yes, Alan, we are in the process of fundraising for our 5th fund under the management of PCP. We've recently concluded our Yield Uganda Investment Fund, where the NSSF participated, which is a learning for them and a learning for the industry about local participation. And indeed, Yield is one of the first, or if not the first, locally domiciled fund, something that we shall be discussing in domiciliation and regulation. So it has been one of those funds that has enabled the industry catalyze. I just wanted to speak to it since we've recently just concluded that fund with 15 assets. So we're in the market for now a regional fund, which was initially our structure of operation, Kenya, Uganda, and Tanzania being core, with Malawi, Ethiopia being areas, and Mozambique where we participated with our previous funds. So we'll be looking for a core regional East Africa fund with at least a $75 million close. The markets, of course, are difficult, and maybe this is not the point to speak about the headwinds in the fundraising market, the debt overhang, the distress in COVID and all this. The markets are hard, and would like a close, this year. That of course remains something that we must work hard at, and we must remain realistic too, given the headwinds in the fundraising market. But sure, we are in the market pushing for a fund.
Wow, great stuff. Let's give a big round of applause to David, Carol, and myself. I hope you have picked one or two things from this conversation. What we have seen in the past 15 years, what is present, but also looking forward. We see that we have local managers who are fundraising to invest in local businesses, but the challenge is that we are picking this money from outside Uganda, and the interest is to pick that money from Uganda. It's a lot cheaper, it's a lot easier. The process should be much shorter. We are looking forward to expanding this conversation in the day 1 and 2, and thank you very much for listening to us. Looking forward to side chats with you later on in the day. Thank you.
I'll ask the discussants to first take their seats in case we have a few cute questions coming in. Another round of applause for members. We've had the opportunity to have our cups of tea. Let's make it louder. Another round, please. Very interesting stuff. Key takeaways. In the beginning, if you were here when Alan was making his speech, we said this is a forum where we're linking both the demand side and supply side. So if you're looking to attract capital, David has mentioned that the agribusiness is attractive, fintech in the financial space is attractive, and other sectors that he mentioned. David is a realist. He did not make it rosy, so it will take us 10 years. to be able to see another listing. So, in as much as we appreciate one of our sponsors, Capital Markets Authority, and we know your interest and passion of getting companies listed on the exchange. David is a realist, and he said 15 years. So maybe somebody in the congregation has a contrary opinion or something to add. I like that Alan is passionate about pension funds. We have a very low uptake of the private equity, and we had Caro to offer us a solution by saying, wait, you're looking for liquidity, we can actually still invest in private equity, as well as provide liquidity. So I'm happy. This is the space where we raise questions, and we also have the members amongst ourselves to give us the solutions. Thank you so much, members of the panel. In a few minutes, but just before we go to the Q&A session, I would like to recognize that in our presence, we've been joined by the Acting Commissioner, Mr. Joseph Enyimu, the Acting Commissioner, Economic Development Policy and Research, who is here representing the PSST of the Ministry of Finance. Just let's take a moment and welcome him. You're most welcome, sir. Thank you. So at this juncture, we'll take a few questions that our discussants will be able to respond to.
Good morning, everyone. Thank you very much for the presentations. Quite very exciting on what has been shared. Mine is to David. You talked about a round of funding that you're working on. All the conversations have been centered around pension funds, as those are the people you think have the capacity to give you this kind of liquidity. What is the opportunity, the chance for individuals to come and participate in these funding rounds, to be able to partake in these huge returns, but also boost an investment culture and also a higher returns perspective compared to the usual investment patterns we have? Plots of land, money lending, mention it. What do you have in your spaces for us, the Muntu Wansi? Thank you.
Thank you very much, David, Carol, Alan, for that very engaging discussion. I just have two questions for David. I heard Carol talk about her exit strategy. I mean, you do mezzanine debt. The exit strategy is very clear. I'm just curious, the yield fund, how does your exit strategy look like? Then my next question would be on returns. I mean, how does IRR look like from your experience?
One more question here.
Thank you. Good morning once again to everybody. To David and Carol. Carol mentioned something to do with business models, and I wanted to understand the businesses that you've so far invested in, especially within Uganda. Are there specific unique business models that they are following? And if they are there, can they actually be replicated by other SMEs so that they're also able to get such funding from the PEs? Thank you.
Question.
Hello, thank you very much. Thanks a lot, Alan, for your submissions. I liked when you said that without capital, you don't have a market. That is true. Today, I'll be wearing my hat as a fund manager, okay, with Old Mutual. And one of the reasons why fund managers rarely invest in PE is because the meeting is dead right from the beginning. Because the first thing you state is that minimum deal size is $150 million. Now, first of all, we have limits. Even if we invested the full capacity that the that Ubra, our boss there, allows us to invest in PE, it will be so small compared to the money that is being looked for. So, dead on arrival, before we even begin the meeting, our ears are closed. Now, one of the things that happened when I started working in the interest space, one of the goals was to simplify a product in such a way that the market will buy into it. No matter how complex a product is, it's so easy to raise capital once you make it as easy as possible. Now, as a fund manager, we are always looking at portfolio diversification. We are looking for a product which, even if the return may not be very high, but the risk will be diversified away. It will make a lot of sense. Let me give an example. One of the things you need to probably think about, because quite a number of trustees of some of the funds we manage are here, and during renewal of, when they are looking for fund managers, the commonest question a trustee will ask is, Zach, for the last 5 years, you've been telling us the same stories, equities, bonds, treasury bills. Is there something else? So, about the issue of appetite, there has never been a greater time for appetite in PE like now. But now it builds those questions, like David, you are saying, the professionalism around. The only reason why Ubra gives us a small exposure is because we have not built or demonstrated. We have not demonstrated that we can invest pension money prudently and generate consistent returns. That's the only reason. Otherwise, if we did that, those limits would be increased. So what I would advise, as you scratch your head, probably think of smaller deal sizes that you can come to us as fund managers. We are ready to invest in PE. If the deal sizes are small enough, even if you divide those deal sizes by the number of fund managers in this room, if they are within the Ubra limits and significantly lower, worst case scenario, on a portfolio level, we have diversified away that risk. Now, if we are successful in those small deals, there's a momentum that's building, there's a track record as we keep on growing towards bigger and bigger deals. That's what I would advise. And once that is done, I do not see how fund managers, who I think we are targeting, of course we are listening to so many other investors, but fund managers who are dying to invest in PE are trying to say, how do you invest in such a way that our risk is low, we have spread our risk, such that worst case, we're still positive. I mean, we invest in equities, which right from the IPO, the price tanks. But why are we still there? Because of the structures we believe will pay off in the next 5 years, in the next 10 years. And actually, Alan, the reason why you would want pension money, surprisingly, it's patient capital. Pension money is actually patient capital. We're not looking for money in 1 year, in 2 years. Otherwise, we wouldn't buy shares. But the question is, how can we go for, how can you structure PE products which are small enough for us to sit with our colleagues in various funds, and we split across, we diversify that risk, and we start having a track record. In conclusion, there are some trustees who will actually tell you they have gone into PE independently. But most of the clients who have gone independently have made losses. Whether it is in real estate, whether it is in REITs, they have been burnt. And that's why there's that negative attitude. But for us, we are ready to invest in PE if you can have those small deal sizes which we can invest as fund managers. And I can assure you the business will grow. Those are my submissions. Thank you.
Okay. Thank you so much. First round of questions, I think they've been clear. David will go first. Carol, you have 2 questions. Zach's question was a concern that needed a clarification or a comment. So I'll pass that to David or Alan or both. Yeah, thank you so much.
Omuntu Wawasi, this is a big problem in this market. Everyone is so individual. They want to do things directly alone. The design for example, I was just having a conversation with someone and I said, the stock market is a clearing area. It's not an area for individual players to come and play picking stocks. It's a clearing area in the market and a price definition area for a broader market. What am I saying? I'm saying as individuals, when you go to stock pick, you certainly put yourself at very big disadvantage as a player. So using collective investment schemes is actually where you should be playing, so that your risk profile is defined, and the collective investment scheme can now make the investment for you at the PE market or the public market. There's no way we can have or develop a market with individual players, because how many interests are you going to have to manage, as a PE practitioner? So that one, I clearly say the route for Ugandans to participate in the PE market is to invest in the unit trusts or collective investment schemes that are looking for allocation in the private equity market. Now, as we are trying to attract the pensions, which will have diversified your risk profile across different contributors, and then we're trying to attract the pension to bring the PE money in. If NSSF invested in the yield fund, indeed you did, and you should be proud of that. Now, exit. When we're discussing exit for the yield fund and strategies, our reality, and this is the reality of what we faced. Yes, we wanted to be an equity fund first, and then debt. But the reality of the matter is, once you go down into evaluating businesses and trying to reach valuations with promoters, you look at a business and, he's making an EBITDA, sorry, I'm just going to go a bit lingo, earnings of about 300K, then you tell the guy, your business is 10 times EBITDA, that means it's just 3 million, and the guy has built a business for 30 years and he wants 1.5 million, valuation is a mess, yeah? Because he says, I can't be worth only $3 million. I have 20 children, I have 5 houses. It's just not possible. So what we do in that situation, we've designed mezzanine structures to enable us as yield fund and debt structures to exit these businesses. That has been the reality. Or we have some runners on performance, that put debt at a very low price, but then if EBITDA is here, we take a percentage equivalent to what would have been our supposed dividend from the business. That's how we try to apply equity risk to these projects to enable them access capital, and indeed access capital for longer terms. We are an impact fund. IRRs, usually hurdle rates for impact funds, are north of 5 to 6%. And indeed, we get around there on a net IRR basis. But these are, of course, matters that are subject to confidentiality.
But before we lose the Muntu Awansi, I want to say one thing, that for smaller checks, 10K, 5K, I think it's more important to focus more on an angel fund. But that is very, very early and super risky for an individual, because you are trying to work with an idea out of campus. You have somebody who has a master's degree, they have a prototype they want to build, and the best capital for that person is family and friends. So this is where individuals will really play. Actually, one of the things I'm exploring is does it make sense to build an angel fund for Uganda? I know we're still working on deal flow, the accelerator. How do we make sure that there's enough businesses coming through? Do we have a structure to translate a PhD thesis into a younger company that then individuals can provide capital to? Because Carol and David, their ticket size will be 100K. But a super early company is too small to fit into where they are, but there's need to bridge that gap with where individuals will come in. So there is space for Muntu Awansi, but even this Muntu Awansi may not be the bottom of the pyramid. This is still a person who is in Nigeria, in Nalian, in Tinda. This is a person we are looking at, because you must be comfortable to put together $20,000 and have this money not available to you for at least 10 years. As this business matures and morphs before it's acquired by bigger VCs and PEs. So these are all things to have at the back of our minds. That is an ecosystem. There are people who invest very early to get the idea out of the blocks, and then there are investors that accelerate this idea before it becomes available for IPO about 15 years down the road. So understanding that framework, it gives us strategies on how to position ourselves in the journey of a company. At every point of the journey, somebody is making money, but those who come in early and the company succeeds become billionaires. Those who wait for IPOs will always cry when the price goes down after IPO. So there's always risk and reward depending on how you have helped the company change, because that's where the value is. If you wait for MTN to come to market, perhaps you're not adding as much value to MTN, but if you are investing in Bienzika much earlier, or you are investing, the professor for COVIDX, if you are investing in COVIDX early, you are likely to have super high returns. So bear in mind those things, but there is a space for everybody to play in the market. Carol?
Maybe I'll just start off by talking about what David talked about on the Montua 1C. Without forgetting them, I'll still support David's submission, because the best way for Montua 1C to invest is through pension funds and the like, because an individual investing into a fund like Yield Fund or our African Rivers Fund, that person will be termed as a high net worth individual. The AML or anti-money laundering checks that are done on that person are too many that it's not worth it. So through pension fund would be the best route, apart from if you're going to go into angel investment. Just to go into the question of business models and what is unique with these models that make us invest in them, we'll appreciate, and I think David and other fund managers would appreciate that with PE, you're investing in the individual more than the company, because the most important thing is the vision, the organization, and what they are willing to give up to make this work. I'll give an example of, you've gone for a site visit for a company that is looking for capital. This company maybe manufactures paper, but they do not have the right measures to avoid fires. So that means if a fire comes, this company is going down. So with this, you're looking at the individual and what they're putting in place to make this work. What is their vision? What are they willing to forego to make this work? As the entrepreneur, even the best ideas, if a best idea is given to someone who is not the right person to foster that idea, it won't work. So there's really no model to say for the businesses, but for as long as it's a viable business, the entrepreneur knows what they're doing and they're willing to make this, go to another level, you can work with that. Yeah.
Thank you so much, discussants, for that. Thank you. Another round of appreciation for the team here. As we ponder, as Alan was talking about angel investors, he categorized it as the Muyenga category, Najera, Nalia. I'm here wondering what happens to the Chevando category. Probably by the end of the 2 days, we'll find answers to that as well. Thank you so much, discussants. As you take your seats, we'll have a sponsor highlight from the Deposit Protection Fund of Uganda. Thereafter, we shall have a keynote speech from the CEO of Capital Markets Authority. So shortly, our sponsor highlight. Thank you.
It's our mission to secure your money.
Protecting your money is as important as earning it. It is for this reason that the Deposit Protection Fund of Uganda, DPF, was established by the government of Uganda to provide deposit protection to customers of regulated financial institutions. In the unlikely event that your commercial bank, credit institution or microfinance deposit-taking institution fails, the DPF will pay you up to 10 million Uganda shillings. Keep your personal information such as national identification number, mobile phone, or an alternative bank account updated with your banker. Terms and conditions apply. For more information, contact DPF at Aha Towers, Plot 7 Lodell Road, Kampala. Call 0312 206 400 or visit our website at www.dpf.or.ug.
We protect your money.
Thank you so much. Members, just to have your attention back to me. I know we are pondering on Chebando, but we'll have an answer to Chebando by the end of the 2 days. May I have your attention, please? It is my honor and privilege to invite Mr. Keith Kalyegira, the CEO of Capital Markets Authority, to come and make his remarks. And thereafter, sir, you will invite Mr. Joseph Enyimu, who is here on behalf of the PSST of Ministry of Finance. Ladies and gentlemen, let's welcome.
Thank you very much. Good morning, everybody. Good morning, Bwana PSST for 2 hours. Most welcome. Mr. Enyimu is also my board member, so he's here wearing many hats and chairs the Research and Market Development Committee. So most welcome. So all protocol observed, thank you very much for making the time this morning to attend this important conference. As Alan mentioned in the beginning, we foresaw that the CFA will be a very important partner, and their whole mission and what they stand for, what they try and do in any economy they operate in, is really to develop professionals. And we saw the need to strengthen the caliber of professionals in this market, because those are the rainmakers, those are the ones who make things happen. It's not us, it's not the exchange, it's not the law itself, it's the players who actually initiate transactions and who actually help grow our market. So I want to thank the CFA Society of East Africa for taking the initiative to organize this alternative investment conference, unlocking local capital to transform capital markets. Alternative investments provide room for diversification outside the traditional asset classes. The uncorrelated nature of alternative assets makes them suitable in minimizing portfolio risk and enhancing risk-adjusted returns. And this really speaks to our support for this conference and for all the work that the CFA Society is doing as we continuously look for an avenue for drawing attention to alternative investments. And I learned this morning that alternative investments includes infrastructure. We're all users of the same infrastructure. I know there's a lot of discussion of the rough terrain we all travel on every morning, but I'm sure it's a concern of everybody. But I hope at the end of my remarks I'll have painted a bit of a realistic picture of what we can and cannot do. And I was just chatting with my colleague Alfred Kabuchu that at the end of the day, the biggest source of any form of repayment of debt or equity is revenue. And you will not find a company existing in an economy that generates more revenue than the government is able to generate in tax revenue. You can start checking with Google. Starting with Google itself, look at the revenue of Google and all those big multinationals within the context of the US economy, which collects about $2.4 trillion in taxes every year. The last time I checked, it might be slightly higher. So any form of financing of infrastructure, and it's a government that leads the investments of infrastructure, has to be financed through tax revenue. There are no creative ways. Whichever way you package it, ultimately it falls back on your ability to generate revenue from that investment. So the alternative investment space encompasses commodities, real estate, and private capital. But this conference is going to be focusing a lot more on private equity, that's debt and equity. The National Development Plan tasks the Capital Markets Authority and relevant agencies to strengthen the private equity framework to allow for the domiciliation of private equity funds as an alternative financing source to the private sector. And this conference will be providing a platform for conversation for the development of private equity. Just going back to Alan's comments, when he talked about pension funds from Norway investing in infrastructure in Uganda. Now let us say you're going to build a power plant. Quick illustration, the equity portion will be about $200 million. And if you have $1 trillion in assets as a pension fund or as a nation in pension funds, it's easy to drop in $200 million. But $200 million against our total savings in Uganda right now of about $5 billion is about 4%, as opposed to 0.02% in the case of Norway. It's a much easier decision to make to drop 0.02% in an infrastructure investment, as opposed to dropping 4% in one power plant. So let's be a bit realistic about what we can and cannot do with our savings. As somebody said, you know, without savings, without cash, without capital, you can't talk about, you can't talk about a market. And the main source of capital is savings in any economy. And I was just asking whether we really have pension funds. How many funds pay a monthly pension on retirement? When we talk about pension funds, we're talking about retirement benefit funds, but those are lump sums. And that's why this conversation about pension reform, I think, needs to remain or come back onto the table, because there's no monthly pension of payments, monthly pension payment to any retiree. And that is truly the source of long-term capital. So this conference is not only timely, but is expected to help deliberate on questions like why Uganda is lagging behind relative to the regional peers in attraction of private equity. Is the challenge a restrictive regulatory environment? I think we've been doing quite a bit of work on that. Can we revitalize the discussion on pension reforms? I think we should. And there's so many ways of doing it. I'm glad that the bill to establish a public service pension scheme is now in Parliament. Should it be restricted to civil servants or all public servants? Does Uganda lack a bankable investment pipeline of businesses to invest in? I'm happy that the society has prepared an array of investment professionals to answer these questions over these few days, and I restrict myself to the regulatory environment discussion. As CMA, we've taken an interest in the whole discussion of private equity because we recognize that capital markets is not just about listed equity, public equity, it's about all forms of non-bank financing or market-based financing. So we are as concerned as you are about why savings are not being channeled into private equity and then through private equity funds into the real economy. Hence, some of the reforms we're undertaking to make it clear what private equity should be defined as in the Act. Right now we have only venture capital defined in the Act, and it has a very odd definition that restricts the limits of equity and debt. So there are amendments underway that we hope shall be completed within 12 months that really makes it clear what private equity is in the Act. So we're looking at expanding the definition of what a private equity fund is. As David mentioned, we've approved the yield fund, we approved Pearl Capital as a fund manager. We didn't actually register the yield fund, but we need to be able to register private equity funds, not the fund managers. I also wish to mention that through the Presidential CEO Forum, the authority has engaged numerous stakeholders, and eventually the head of state, in his wisdom, saw the need for tax exemptions to be allowed for private equity funds. Yes, you can clap. I'm actually surprised that these amendments that are being talked about right now on the tax reform haven't addressed some of these issues squarely, and we need to take up this discussion. David was part of this team, and Edward as well. So we need to make it clear that as soon as possible. I think we still have a short window for amendments into the final budget pronouncements to make sure that his wishes are actually captured in the income tax amendments. Some of the things we're looking at are reduction of stamp duty for acquisition or disposal of interest in a portfolio company by a private equity fund, reduction of withholding tax on dividends, maybe even elimination completely of withholding tax on dividends, because private equity funds are really pass-through vehicles. You shouldn't be charging this fund that's going to be passing on these returns to the pension funds. So there should be total exemptions on dividends earned by a private equity fund from its portfolio companies, and then exemption of private equity funds from capital gains on the disposal of interests in portfolio companies. So these are the three main measures that we're hoping will make it into the income tax amendments. Through a collaborative engagement with the East African Venture Capital Association, IFAD, the International Fund for Agricultural Development, and the European Union, a study has been undertaken, has been concluded, identifying the constraints with the Partnership Act that is deterring the domiciliation of private equity funds in Uganda. The key highlights of this study recommend for the amendment of the Partnership Act to allow for voluntary winding up in accordance with the partnership agreement, allowing for transfer of partnership interests to provide flexibility in relation to changes in membership, and thereby clarifying the existing pain point on challenges with exits, and expounding on the nature of capital contribution, e.g. cash, property, or services that may be made by an LLP, a limited liability partner. So now what is left is really to just share the findings of this study with the URSB, the Uganda Registration Services Bureau. So for purposes of mainstreaming these amendments in the Partnership Act that was first established in 2010, with the regulations that followed in 2016, but they're a little bit awkward and need to be improved. So this juncture, join me in thanking all these stakeholders, the Presidential CEO Forum, I think David is represented, so you can clap. The East African Venture Capital Association, I did see a member here somewhere behind Dorothy. The European Union, is there any rep? IFAD, and the CFA Society for being reliable partners in advancing the policy proposals expected to enhance the development of the private equity space. I know that there are some other developments that are taking place in the area of artificial intelligence, but we're taking note of those developments because we know that they're going to be impacting the whole world of finance as we know it. So in conclusion, allow me to reiterate CMA's ironclad commitment to fulfilling provisions of the Memorandum of Understanding signed with the CFA Society of East Africa. We shall continue providing the necessary support for the initiatives that will build competencies of capital markets professionals as we seek to unlock capital to transform capital markets. But before I conclude, I want to just make a few comments, since I have the floor, on some of what was said about the integrity of financial statements. I think that was Carol in her presentation. Very, very important. And I was once chatting with a US investor who said that if a CPA signs off on financial statements and they're found to be defective, they're banned for life. That's how serious the CPA profession is taken in the US. So similarly, if an SCCA or a CPA Uganda signs off on financial statements, they should be taken as foolproof. But many times you find yourself having to hire somebody else to look through those financial statements a second time, do due diligence, and then the consequences really are not punitive. So we need to do ourselves a favor and get really serious about the quality and caliber of professionals. And each one has a responsibility of trying to raise our voices to the ICPAO and making so that it's clear that it's totally unacceptable for a member of CPA to sign off for statements that are found to be defective. Another comment I wanted to make was about the development financial institutions' role and in driving capital development. Now, many times the DFIs say that they are very interested in developing capital markets, and they do play a very important role. We saw them participating in Mujagali, for example, but somehow when the project has been de-risked and as the power plant or whatever it is has been commissioned, somehow the D seems to fall off and they become financial institutions. And they just start enjoying the cash flows from it. So this is the challenge I'll make to every DFI, and every opportunity I have, I'll throw that challenge to them that they need to walk the talk and be consistent in their playing their development role. Local pension funds, I believe that the moment we move away from paying out lump sums on retirement to paying monthly pensions is the only way we shall be able to develop longer and deeper pools of long-term savings for this economy. Thank you very much, and I want to use this opportunity to invite the acting PSST for 2 hours to give us his remarks. Mr. Nyimu, you're welcome.
Thank you, Keith. The Director and Chair of Certified Financial Analyst Society East Africa, the CFA team present, our distinguished entrepreneurs in the room, and also the eminent professionals in this space. Ladies and gentlemen, good morning. I bring you apologies from PSST. He was not able to come here scheduled. He had an impromptu requirement to attend to business in Parliament, and so he tasked me to represent him here. And it's a very high honor for me to interface with players such as yourselves, because you decide where the fuel of this economy flows, and your decisions can make or break some of our economic targets. So it's very good to listen to you very keenly. It was a pleasure getting a feel of the discussion here, and it was music to my ears, because it is this kind of discussions and the outcomes from them that ultimately drive some of the concerns we endeavor to address at the Ministry of Finance. Concerns such as jobs, tax revenue, and the wider competitiveness, of course, of the economy. So allow me go straight to the remarks I'm here to deliver. The researcher in me, of course, will chip in with a few numbers and comments in the course of these remarks. To amplify or illustrate some of the points I'll be making. So I am pleased to be here with you as we deliberate on the alternative investments critical for our economic transformation. For a long time, both at continental level, but also regionally, we have relied on multinational corporations in one way or another to drive the investment agenda on this region. And depending on the extent to which these multinationals develop linkages with our local SMEs, that has curtailed the degree to which we have been able to speed up our liberalization process, and also to unlock the local entrepreneurial spirit, and therefore generate opportunities within the economy. In Uganda, there are numerous micro and small businesses with very few medium enterprises. This has had effects on forward and backward linkages, job creation, and revenue mobilization, among others. This conference, therefore, is timely as we discuss here amidst the innovators, startups, incubators, micro and small business owners. We must acknowledge the critical role businesses play in our lives and in the economic transformation agenda of the country. Ladies and gentlemen, sustainable investments, especially startups, are the new frontiers of growth and transformation in any economy in this modern era. They are the new backbone of sustainable transformation. Countries compete on the level of their innovation quantum. We see this, among other things, by the number of intellectual property registrations that people do with the WIPO. We must therefore provide the necessary leadership and support frameworks to create new businesses that are ready to disrupt not only Africa, but the global value chains. If we want to be really effective in building up and reinforcing disruptive innovation ecosystems in Africa, we must be able to do this together. Successful investment ecosystems are embedded in networks of founders and partners. Ladies and gentlemen, this is possible if we can focus on interventions and investments geared towards structural transformation, technological uptake, enabling innovations, and strategic linkage services. That's what enriches this ecosystem. Allow me turn back on a few aspects back home here. At the Ministry of Finance, we have a vision, and that is a competitive economy for national development. And competitiveness is basically about your edge in terms of putting things across your borders or being able to generate substitutes for them within your local economy. And that vision, we actualize it through an investment strategy, which is four-pronged. Number one, we look at lowering input costs. People seeking to deploy capital, I think their number one parameter on their radar is the market. Is there purchasing power to generate the revenue stream that Keith talked about? And that's a big consideration. So we deem it necessary that we are able to lower input costs so that you can up the profit margins and of course return to the investors. Consequently, we are deploying public resources in the major drivers, cost drivers of enterprises, namely energy, transport, capital, and raw materials. We advised in literature that for most companies in the tradable sector, these input costs could range between 50 to 60% if you put in the logistical element as well. The second aspect of our investment strategy deals with lowering transaction costs, business licensing reform, custom clearance. You're familiar with the electronic single window and the one-stop border posts. These are all geared towards efficiency and cost reduction in the transaction process. Also making tax compliance easier. We have, of course, a number of entities maybe in the room. You are among the authorized economic operators. And then the other big one is internet costs. We have made some good mileage on this with the national backbone, and now we are deploying the last mile connectivity as more businesses start relying on this infrastructure for their transactions. The third element is on lowering overheads, and these are really for the bigger SMEs. We are progressively increasing the number of serviced industrial and business parks, and also logistical hubs. We see ourselves as a logistical frontier country into the hinterland of the EAC, and so it's important that we make that movement of goods easier. And then finally is really reducing the regulatory burden. Allow me paint a picture here of the investment landscape really at an economy-wide level. As part of managing the public investment management function, the ministry conducts a regular exercise in terms of updating the key parameters that guide project appraisal in Uganda. And we have developed country-specific commodity conversion factors. And as part of this was first done in 2017. We did an update last year, 2022. And we're able to establish from that process that return on domestic investment in Uganda has actually improved from 12.1% to 13.6%. The other highlight was that return to domestic savings has also improved from 6.5 to 7.5. And the marginal cost of foreign borrowing has gone down from 11.4 to 7.2. In other words, on a wider scale, I think that the bigger considerations for entrepreneurs are on an upward trend, which is good for our standing as an economy. Now, when we talk about competitiveness and market, which is critical for players like yourselves as you seek to deploy the savings that have been mobilized in the economy, the ability to export is, of course, key for the country. We now have a population of about 45 million people, per capita income of slightly over $1,000. And the average wage for a Ugandan that derives or works based on paid employment is only 200,000 Ugandan shillings per month. So the number of Ugandans, according to the African Development Bank, who can be classified as a middle class. These are people who have expendable income of $2 to $4 per day. Is not very large. I think we are about 35% of the population. So whatever we do, we must make sure that we up our export capacity, and from our side, making sure that private savings are able to find their way into SMEs that are delivering to the export market then becomes critical. Now, how do we link up national savings to finance our export agenda? According to the IFC, they did a study, I think last year, 2022, and they established that the estimated demand for credit by micro, small, and medium enterprises in Uganda is at about 31.4 trillion shillings. That's about 8.8 billion US dollars. That is the demand for credit. On the other hand, Uganda's savings to GDP ratio as of 2022 by the IMF was 20% of GDP. And with our GDP headed up to 50 billion US dollars, that would be about 10 billion US dollars. What does that say? Clearly, there is more money in the system than SMEs need. And the key question, therefore, is, are the entrepreneurs looking to the right places for the right financing? Are we able to intermediate these savings to drive the credit needs by these SMEs? And of course, that brings us to the space that we are speaking in today. We did a quick look within the ministry about the size of the PE, private equity, and debt transactions based on Keith's report for 21-22, the industry report for the capital markets. Private equity and debt deals in Uganda 2021 was about US dollars just 51.6 million. But as we speak, we are aware that under USAID, they have what they call a strategic investment activity that is seeking to deploy about USD $140 million targeted at about 100 companies over the period 21-26. IFC, International Finance Corporation, currently runs a portfolio of about 155 million US dollars. And have been able to invest since their founding in Uganda 1997, about 56 companies to turn them around and make them viable businesses. And then of course there's the big push by the US International Development Finance Corporation, 60 billion US dollars. Sub-Saharan Africa since has been able to attract just about $369 million. I'm not aware of a Ugandan company that is benefiting from this financing. So far, maybe you are the experts, you know better. You could advise on what we are doing to tap into the money under the Development Finance Corporation from the US. In terms of development finance, we are familiar with government's investments in UDB. Not so much venturing into the private equity, UDB at about Uganda shillings 140 billion. We are supporting firms that are playing into the export market and hopefully seeking for more capital that PEs in the room can also inject in. We have some things in the pipeline, what we call a project dubbed Investment for Industrial Transformation and Employment, which seeks to leverage some private investments within the export and manufacturing sector. The financing for this is before Parliament as we speak for approval. It's about USD $218 million over 5 years. We think that with a leverage ratio of about 1 to 3, we should be able to create vehicles that some of the PE players in that space can invest in. And then, of course, commercial bank finance through the agriculture credit facility is also supporting some of the farms that could be candidates for private equity or even debt finance. Finally, the ministry has embarked on a process of establishing a climate finance unit to tap into, the money floating in the global system for climate finance. But what emerges out of all of this is that de-risking the financing ecosystem is very, very critical if we are to be able to mobilize more financing, but also to increase the appetite of PEs to venture into these companies. So among the things we are looking at in terms of improving or de-risking the export trade, we focus on export, yes, for the reasons I've told you, market. The internal market is not so big given our income levels. And so if you're really looking at becoming a player, a player that can eventually, provide an IPO, I think that you have to be plugged in somewhat into the external, the export market. And I'm happy to announce that there are a few Ugandan brands that have crossed the borders. I think you're familiar with a local brand called Move It in the cosmetic space. I think they are now in 6 or 7 African markets. Of course, we have the likes of Roofings also becoming a regional brand. Yeah, even in the dairy segment, Pearl Dairies, we are crossing borders in terms of exports. So there are a few national brands that are starting to attain a regional footprint. To support this trend, we are looking at an export credit guarantee scheme. We, through the Uganda's Bankers Association, are interacting with them on a regional export facility. We hope that the public and private sector can be able to forge a cooperation to lower the risks associated with export trade. The other avenue is really upping structured trade. If we are to deliver commodities, especially in the commodity space, as I noted that commodities are among the alternative investments we are talking about, we think that the work going on in terms of reviving the Uganda Commodities Exchange will be very critical. And then also delivering structured deals. These are like government-to-government deals. We are looking at an aspect in terms of coffee, where we can lock in some contracts on a government-to-government level. And to that end, we put together a coffee roadmap, which HE launched in 2017, and we are trying to actualize this. The other one is trade insurance. Trading across African borders can be very risky. And so we are members of the formerly African Trade Insurance Agency. It has been renamed. I'm not sure of the new name. But to buy down some of the risks that our exporting firms are exposed to, we think we can, improve on their prospects to penetrate these markets. And then finally, with over 40 currencies, if not 50, across the continent, the whole challenge of cross-border payments is a very big cost. So we are trying to lower that down through a range of payment platforms, including the East African payment systems, and then, of course, the Pan-African payment system that has already registered 9 countries. Bank of Uganda has advised us that the Secretariat in Ghana wrote to them, and they are considering, they are studying the participation of Uganda in that continental payment platform. What's the way forward from the way we look at it? We think that UDB and UDC need to accelerate the setup of their equity funds, which are provided within their legal framework. That way, the capitalization that goes into these investment arms of government should be able to leverage more of the resources that are in the hands of private players. Of course, we continue to capitalize UDB to be able to do more beyond what we have done. And then there is the big push now with the parish revolving fund, which is expected to reach 4 trillion shillings by the end of NDP3. How we structure commodity trade, commodity financing, to be able to actualize farming as a business will really affect the extent to which the PDM and the financing that is going into it can speak to our exports agenda, and the development of agribusiness and the investment opportunities therein. CMA is in the room. They have a deal flow facility, and we think that is an effort worth supporting, continuing to handhold our SMEs and calm their fears, but also improve corporate governance amongst them to make them investable by the different PEs that are looking to do so. And then finally, informality is a very big challenge to our economy. UBOS estimates about 52% or 53% of our GDP is generated through the informal sector. So we are investing heavily in what we call mass BDS, Business Development Services. Last year, Secretary to Treasury launched the National BDS Strategy, and we have also provided money to URSB in the coming budget to be able to do some mass registration. We are happy with the efforts under the National Social Security Fund to reach out to players in terms of voluntary contributions, but the amendment of the law also that has now facilitated even one-person companies to be able to participate is welcome news. So with those initiatives, we think that the public-private partnerships can really only grow stronger. And it is on that note that I want to conclude. Ladies and gentlemen, it is a call to all of us to be committed in our professions to provide critical guidance to our citizens to invest in ventures and innovations with a transformative factor. It has been talked here this morning in our panel about a long-term horizon in the way we invest and support enterprises as a critical factor in this conversation. And these ventures should be across all sectors of our society and provide opportunities for our very young population to have hope that there will be opportunities for them as they finish school. So I thank you for your kind attention, and with those remarks, it is now my pleasure to declare this Alternative Investment Conference open. Thank you.
An extra round of applause for our PSST. We've just listened to two very high-profile opening remarks for the conference, and that's usually the church session of the conference. I don't know if you've gone to church, but you can't raise your arm and tell the priest that, I think I disagree with that part there. Or you could tell him, I think that was at odds with section 5 of Corinthians. Do you think you could, you can't do that. So it's, we've been in that, that moment. However, there's been a lot that has been shared that for a moment I sat there and put myself in the shoes of the Chevando investor. And I thought, what's in there for me? And I felt that there was so much. Keith talked about restructuring what we call pension funds. Are they really pension funds if they're not giving monthly contributions to, monthly checks to their members? Carol and David spoke about, Carol is looking for $140 million, David's looking for 75, and the PSST has just said he actually has $218 million coming. So probably you talk to him nicely, you're sorted. Yeah, but there's so much in the pipeline, and I like the fact that the ministry is speaking about
the impact that this sector has. How many jobs? When David and Carol and UAP and all the fund managers here, and I think I need to include Mr. Kamara, CFA from UDB, when you're making all these investments, I think it's important to report about the impact side of it. The exports that we are promoting, import substitution, the jobs that are being created, and all the other good things that we do. To delve more into this, we're going to have a very short panel discussion of about 20 minutes. I'm going to invite Dr. Edward Isingoma, the managing partner of Power Capital Partners, to take us into a 20-minute discussion with regulators, looking at the regulator and DFI perspectives. I'd like to invite Dr. Edward Isingoma to take the floor and invite the panel members. Dr. David, you're welcome. Round of applause for David as it comes.
Good morning, ladies and gentlemen. Good. Very pleased to be here, and looking very forward to this short discussion regards complementing what the earlier speakers have mentioned. And as already discussed, it is very interesting already, but what we want to then hear from, and I think everybody has already said questions like, yes, numbers are being quoted from the CMA report. WUBRA is allowing us to invest a little bit of the capital in PE. And for now, we want to hear from the regulators, get a feel of the regulatory perspective, and a little bit about, or a little bit more about the DFIs. And I liked what Keith mentioned earlier. After investments are done or capital is deployed, the D disappears. And then they become financial institutions. That was interesting because we've seen that in some boardrooms. And very lately, we've seen a lot of DFIs either hiding under impact and talking a lot about impact, but actually it is the return that is expected. So with that, I'll be keen to invite my panelists. It's a small panel, but very important because they regulate all of us, and I'll be very careful at anything I say because my license could be cancelled. But I will request Mr. Keith Kalyegira, the Capital Markets Authority CEO, to come to the front, together with Mr. Martin Nsubuga, the CEO of the WUBRA, to also join me in a short discussion about some anxiety points from the various members of the audience. Good. I will try and have this panel discussion pretty short in the interest of time for everybody. But I'll be keen to engage my panelists with that mindset that comes from myself as an implementer. I would say, as an entrepreneur, being a shareholder in Pearl Capital Partners and running Pearl Capital Partners, and a few times I did mention to Keith that in the next few years as I retire, you've seen my succession planning in how David Wangolo sounds. It is coming to the younger people to deal with this. But yes, private equity has been around. Alternative investment schemes have been around. I would be very keen to hear from you, Keith, how you think practically from a regulatory perspective. You've already mentioned what you're doing, what CMA is doing, what UBRA is doing, what is happening. But from a practical perspective, how you think we can attract a little bit more in terms of alternative financing structures. I must say, from myself as PCP, we've seen that Ugandans don't learn from PowerPoint slides. They really are more practical. If the neighbor plants maize and it does better than their maize, they will start asking, is it witchcraft or is it fertilizer? So we've seen those kind of things. So what are we not doing different? And what can we do different as regulators to try and attract more capital to our sectors? Thanks, Keith.
Thank you. We, over time, began to recognize the growth of private equity funds all over the world. I think about 10 years ago, there were about 600 private equity funds. The last time I checked, there were about 6,000. I read recently there are about 10,000 hedge funds. So there's growth in the private financing space that we can't ignore. And all these hedge funds, private equity funds, are financed by the same source of funds, pension funds, endowments, etc. So we're going to think, what can we do to get our savings as well here channeled into private equity? And so that's really where we're coming from. We also began to notice that there's a reduction in listed companies globally, from 8,000 in the US to about 4,000 today, 30 years ago. Johannesburg Stock Exchange, similar trend. Again, the question, what is going on in the world? Why are those companies preferring to get financed by private capital as opposed to public? We began to look at a census of the listings across Africa, the Middle East. I used to chair a subcommittee of IOSCO, the International Organization of Securities Commissions. And we came to the conclusion that most IPOs are not for purposes of raising fuel, growth capital to finance the growth of businesses. We also realized that there was issues around valuation. We were talking about this earlier. Where do you get the best value when you're exiting? And that 1% is not by accident, or the 3% is not by accident. What are the expectations of investors in the public markets versus private markets? Private markets, those are typically strategic investors. They'll worry with you, they'll think with you, in addition to giving you capital. The public investors tend to be financial investors. Where's the profit? We're not sure what exactly you're doing, we like your business, but where's the profit? We want dividends. So we're really alive to this reality. Hence the need for us to really make this process as efficient as possible. A comment was made by the previous panel that it should be easier to access domestic capital. The question for us is that, is it? And internally we ask ourselves those questions. When somebody comes to us to say they want to launch a fund or they want to register a fund, how easy and swift is it? So we're going on with internal reforms to make it as swift as possible to register fund managers, private equity funds. We realized that we never had the ability to register a fund. So as the reform, I was talking about the law changes, that's really going to help for registration of funds, the actual funds, especially if they're going to be raising capital domestically. I think the trustees of pension funds need to be having the comfort that these funds are recognized and registered with us, hence the adjustments that we're making in our legal framework.
Thanks, Keith. And that's going to be very helpful. I must say, locally domiciled funds are going to be an interesting game changer. But with that, I would be very keen to pick up one follow-on question before I come to UBRA perspective and what then happens. The one extra question I would be very keen for you to address, Keith, is how soon do we think we are going to get there?
I think we're talking about months.
Okay.
Let's say up to 12 months.
Okay, good.
There are certain parts of the legal reform process that is out of our hands. And actually, right now, it's the Ministry of Finance. It's left our desk, so it's now the ministry. I think there's an urgency around it.
Good. Okay, so now we are down to a couple months, and that would be a good expectation, because I think the audience is very keen and eager to hear about how soon will this come around. I'll come down to now you, Martin. Key question for me is, do you see appetite, and do you see from the various fund managers and players and people you regulate, do you see big appetite of interest that is real, or do you see that as something that we talk about? And I'll use a case study. When we set up the yield fund, we got NSSF to invest. But the 2 million euros NSSF invested in the yield fund was like a drop in the ocean to just, okay, we can get it working, we can talk about it, let's see how it works. Today, we've started returning some of that money to the NSSF. This is when you're starting to see, okay, oh, we can actually expect some money back, and it is actually coming. And that is creating a different vibe and interest from an NSSF perspective. And they're starting to say, okay, over the life of the yield fund, over 10 years, there's a chance that we won't have to call down on the guarantee for this facility or first loss protection, but rather have the funds coming back from the fund activities. And that's exciting. But do you see some of the other UBRA members or people you regulate keenly interested and keen to have private equity participation in the real sense of it? Yeah.
Well, thank you, Doctor. First, good morning. I apologize, my voice is very low, but since we're in finance experts room, I'm not exposing anybody, so there's no risk. It's just the environment. I'm allergic to the weather. But just to go back to the point, the second, and also to thank the CFA Society for giving us the opportunity to share what we know, what we see in this space, and also to learn from quite such a big audience. Is there opportunity? The opportunity is definitely there. From our side, as a regulator, we set the standards and the rules from which to operate. The window is there. You can invest in private equity at the maximum of 15%. Is there absorption? No. Actually, it is only, I think, around 2% in that space. So the headroom is still huge. But I think also need to appreciate the dynamics which informs that. This is what we think. Our market is, I think from a structure perspective, has some kind of informalities. You know, the books from the investment side say that you maximize returns from a high-risk investment. In this country, you can get high returns from a low investment vehicle. So that contradicts the principle that is well known. If you still have vehicles that are still attractive in government securities, which are huge and providing huge returns, and with the move, the clients we have, all the members we have in this market, are all interested in returns. When fund managers are making decisions for their scheme members, I think they are paid on the returns they've made. They're probably not made an effort. This is what we think, probably even from your side. When you sell new ideas to these guys, what do you sell to them? If you're paid on the basis of the returns you make, then you are going to look at that return that is going to provide you with that investment, or that's going to give you the good return. But that fundamental is that private equity is a investment vehicle. We've not yet come up with clear, I think you mentioned it earlier. What we need to do from our side, we first set the limits, but also need to come up with a framework that can guide informed decisions to the trustees or the fund managers in terms of how much disclosure do you provide to this scheme or trustees in terms of unpacking who are the sponsors of this vehicle, what are the finances involved, what are the obligations from parties involved, what are the expectations, and also to appreciate that this is a journey that is not short-term, but long-term. If you can begin from that space and also have a few resources to seed with an aspiration of looking at the long term, then you can be able to occupy in that space. The good thing, the market has been tested. The examples we see, we have, I think from our side, we have 4 private equities. You've mentioned them. NSSF is a giant. You have invested in the TPS, the Oldie Fund. But there's also the AP1, which is being taken on by the occupational schemes. But by and large, the amounts there are still not very huge. But it's a learning lesson. I think we've learned from it. And from a regulated perspective, we also know what kind of interventions we need to do in terms of supporting this vehicle, structuring them, what disclosures, what considerations, and how do you manage the expectations of the members and the trustees out there. It's something that we just need to deal with, but I don't think it's something that the regulators alone have to do. You still think you fund managers also have a big role. When you sell new ideas to the audience, what are the considerations you put into? What are the things that you look out for? What kind of information do you provide? They look at it from the long-term perspective, or from the short-termism that we have in this market. Thank you.
Good. Thanks so much, Martin. I'll quickly want to ask about a liquidity question. Do we think mobilizing local capital and investing it in these alternative markets, do you think the liquidity exists? And I think, Martin, I would be very keen to hear from you first.
Yes, actually liquidity is not a problem in our sector. When you look at the asset distributions and the flows in these funds on a monthly basis, liquidity is not a problem. I think what is missing is what are those available options that can attract this liquidity, other than the non-traditional ones, and what would make people be attracted to them. But liquidity is quite in plenty.
Super. And hearing that, to you, Keith, in terms of the risk profile, do we think the masses understand values around, people hear about treasury bills, bonds, and that's it. But then do you think we are doing enough to publicize and share knowledge about the risk profile around private equity, around alternative market solutions, whether people, some of the businesses even we've talked about that have started good brands and are exporting and are going across the region, can they issue, for example, if Movit today issued a debt loan note, will people run around and fund it? Do you think that is possible? Are we there yet?
That should be the subject of a separate conference. That question is a very important question because you're talking about the return on investment or equity of many businesses. You're talking about government's cost of borrowing at 10 years about net about 14%, and you're raising questions like how many businesses consistently pay a dividend of 14% to their shareholders without fail every year. And we're doing some research. I think Dixon's about to write an article on the dividend payment history of the listed companies and what the dividend yield equates to. How many exceed 14% consistently? So it's a complicated situation. I wish, one time I did mention in a public forum that I wish there was a way that the government could put a cap on the rate at which it borrows. Because those mortgages you're talking about are able to borrow from banks at a rate that's lower than the treasury bill, the one-year treasury bill rate, sometimes. Now, that really complicates the whole space.
Many times, I think.
Many times.
Yes.
I'm being a bit polite. That complicates the space for issuing debt, notes, corporate bonds, commercial paper, etc. And then there's another question of what happens after you've issued those bonds, those notes. Do the investors wait until the end of the 10 years before they get paid their principal? Can they trade these notes? And that's another discussion that we're trying to engage with the central bank on as the main issuers and licensors of primary dealers. We're trying to really get this fixed income market, secondary market activated to the point where it's attractive for investors to invest in corporate bonds, commercial paper, as alternative sources of funding for private equity. But I think the main issue of risk for private equity is what are you going to be investing in that's going to be generating returns north of 20% per year consistently, such that the owners of capital can pay attention to you as opposed to paying attention to government. That is the easiest way of deploying large amounts of capital consistently. So, yeah, that's really what we have to deal with.
Thanks, Keith. And just a follow-on quick question. Do you think there is a role to use guarantee models in this space? Or do you think, for example, many commercial banks and financing institutions do access guarantees to the loans that are invested, say, in high-risk areas like agriculture and many of the SMEs. And even when you find the agricultural credit fund facility, there is a bit of subsidization through a guarantees mechanism for the commercial banks. Do you think there is a role and a need to use a guarantee model to minimize risk for the private equity players in this market?
I think it's useful, but the economists will tell you that guarantees tend to create something they call moral hazard, because it's almost guaranteed. So why bother to have that effort, put in the effort to collect? But it does help. It gives funders comfort that at least there'll be some repayment. Mr. Nyimu did mention UDC. So funds, government funds like of that nature can co-invest with other private capital providers and agree to take maybe first loss on certain strategic investments that are going to really boost employment and have other bigger economic impacts. So those are the other forms of guarantees or instruments that can give private capital comfort that, and encourage them to invest in an economy. And also ask yourself, why does private equity have to exit after 7 years or 8 years? Why can't you change your model and have a longer term view of a longer term horizon? Because you put a lot of pressure on the business when you have to exit after a very short time. But anyway, the main issue is really about the comfort. Agriculture by its nature is not a very attractive business. You know, you're talking about it being very attractive, but I think it's almost like a human right to eat consistently. So it's how much can you charge in an economy of our nature with a GDP of about $1,000? How much can you charge for agriculture, for foodstuffs to keep people alive? So they need as much help as possible. And I'm glad that the US, USAID has that program to finance agriculture, and among others. Thank you.
Good. Thanks, Keith. That's helpful, but I think it also goes without mention in some of the conversations I've had with my regulator, that some of the best deals we made, or some of the best investments we made, or when we had the biggest shot at pipeline, was post-COVID, when food was a constant. People had to eat, and it had to continue happening. And then commercial financial institutions struggled to deploy more debt, and therefore people had to think about what do we do as an alternative to financing our SMEs. And therefore the influx and seeing a lot of PE transactions happening just after COVID would be a correlation to this. If I come back to you, Martin, just before we sum up, one quick question that I'd be very keen for you to address is, from a regulatory perspective, do you think we need, as we think about fund managers being created and being regulated and licensed and supervised, do we need to start thinking about how their end life comes? Because what then also happens is, as we set up more funds, as we set up all this, there is this whole animal called closed-ended life funds, which is a standard norm. Even when you have greenfield funds, there is going to be an end at some point. Do you think that requires some regulation as well to give comfort to the investors in the funds? Yeah.
I think to some extent, yes. The issue is how do we minimize the risks, the one I mentioned earlier. Can we look at things that greenfield investment we're talking about? How is it structured? Basic things. Who are behind it? Are they people of integrity? What are they trying to achieve? What disclosures are there for the member? How have they managed those risks that they've identified, if at all they've been able to look into them? And subsequently, how are the likely flows going to happen? And of course, then you look into the other details of what are the controls in place in the event things don't happen? Are there any guarantees or insurance? I, for one, think that the guarantee insurance comes at the end. The basics have to be put right in order. So yes, you need to set the framework. It has to be guided. Otherwise, if we don't, maybe that's why the fears are still there. Maybe that's one way to build the confidence that we want to build in the long run. So it needs to be seen from our side as regulators that yes, it's something that we've looked into. We've reviewed it, we've evaluated it, and we think it is in order and it has followed at least the basic principles to protect the interests of members. And therefore, yes, you can proceed. Not that we are guiding you to invest into it, but rather to provide that kind of assurance of some sort. So the regulation, I think, is wise.
Good. Thanks so much for that. Yeah, because I must say, again, from a Pearl Capital perspective case study, when we had our first fund, the AAC, it lived 15 years, but as that fund came to the end of its life, we really struggled with how do you dissolve, how do you issues around closure of a fund. And once you don't talk about it when you're setting up the funds, it becomes very gray area for manipulation or even abuse. And I think I was very glad that the Capital Markets Authority was very supportive in our process, because otherwise it was a very difficult process, because it was the first time we set up a fund in Uganda, domiciled it here. It lived its 15-year life and had to liquidate and close down and return capital to the investors. And that was a tough process. If I may move just before we open it to the question Q&A session, I'll be very keen to hear about, we are talking about this from a regulatory perspective, from a capital market side of things, and from a UBRA side of things. But are there other things that we think, and I'll be keen for both you, Martin, starting with you, Martin, and Keith, to share with the audience, are there other regulatory perspectives that need to come in as key stakeholders in this process as we open up the capital markets activities in this market? For example, are there things we need to do around the legal framework? Are there things we need to do about the tax regimes? Are there things that, 2 or 3 things you would love to share with the audience about other regulatory frameworks that need to also come in handy as we get to improve the capital markets in this market and have this as a hub? Yeah. Do you want to go first? Yeah.
I did talk about the tax, which is already under discussion in advanced stages, also the regulation and registration. But perhaps the third one, and the only one from me, would be the collective investment schemes. I look forward to the day when 10% of the total assets of a collective investment scheme make a meaningful contribution into at least 2 or 3 private equity funds. and that these CIS managers can set up schemes that have a long-term payback to the investors. And that's the one way I think the individuals can participate through private equity ventures, as opposed to trying to contribute their small savings directly into private equity. It's too much of a headache to try and get individual savings. So I want to see more savings going into designated collective investment schemes that are going to be investing in private equity ventures. And these funds can even be listed on an exchange one day to provide that liquidity for those investors who change their minds about waiting for the 8 years. So that's really, my expected and desired forecast.
Thanks, Keith. And Martin?
Yes, I think in addition to the tax issues, from our side, this is statistics. You have a portfolio of around 21 trillion to date, but if you looked at NSSF to date, which is around close to 18, thereabout. Now, the concentration of people who are about to exit NSSF, who are 45 years and above, is probably accounting for almost a third of the portfolio in NSSF. So the issue is, if you are looking at long-term investments that would have a drop in the portfolio in the next 15 years that is significant, there's need to rethink the legal framework. I think it comes back from what Keith said earlier. Can we begin to think about preserving these funds and get pension payments? It's a very delicate matter, which many of you don't want to listen to. That one can be testified from the midterm access pressure, but the issue is, what is going to give you that certainty of cash flow is the pension arrangement. But from the discussion we're having today, to have that long-term liquidity and investment vehicles that we're trying to talk about, we cannot ignore that drop that can distort the financials in this market. The second one is more again from I don't think it's really a regulatory framework that we need to do. I'm thinking just need to come up with a clear framework which is not regulatory, operational wise. How do we, I think this is Keith on your side, how do we journey those simple unquoted equities and help them grow into being quoted? Do we have a clear framework that can help them with that? A deliberate effort to have those with clear support if necessary. But the idea is that you need to think of growing them to that next level of attracting the liquidity. I listened when the PS was talking about the 4 giants that are exploring into the international market out there. I think he talked of Movit, he talked of roofings. Then I asked Keith, where are these people getting their capital? Why are they not listed on the stock exchange? But it's not an answered question. It's not answered. So these are things to think about. Is it a limitation from the legal framework that we need to think through? Maybe there's something that we've not done that we need to explore. Thank you.
Good. Thanks, Martin. And just before I pick up on a few questions from the audience, we've not talked a lot more about the DFIs, but I would ask my panelists to, if you had a wish to the DFIs in the room, what would you say you'd expect them to do differently from a regulatory perspective, from what is happening today? Martin, do you want to go first?
I can go first. Well, first of all, what drives them to sponsor this kind of, or to promote this kind of vehicles? I think we need to begin from there. Can we minimize our expectations and weigh hard of championing a vehicle that is going to generate benefits in the long term, rather than looking at an immediate return for us? Thank you.
Good. So the request from Martin would be more developmental, be more long term. Look far ahead. Good. Keith?
My short message would be de-risk and exit through the capital markets as soon as an investment has been de-risked.
Super. Consider exiting through the market so we can have a couple of them coming through the market. Good. I'll be happy to pick up on Any on questions? From the audience, but we'll take only a few because we've overshot our 20 minutes. But we'll only take maybe 4 questions maximum to the regulators. Any questions from the audience? Whether there are questions or comments, I know it's coming to the lunch break and we still have one more session. Yes. Please.
Thank you very much, and good afternoon, everyone. Yeah, it's good afternoon. Thank you, panelists, for the good discussion. I think the current panelists and the ones before. As we discuss this space, and with the team we have here and the PSST, I noted when the PS was discussing, he indicated that the input costs cover about 50 to 60%. And then I think Keith has indicated that when the investors are coming in, they are looking for something up to 20% return. And from experience and information in the market is that, especially in Uganda, and I think generally in East Africa, the taxes consume about 50 to 60%, depending on the business. And so when I was adding up, and then there was a discussion also on the valuation of businesses as one of the concerns when you have PEs coming in, or when you have investors coming in, they want to be able to value a business properly and expect a return. So when you add up all these figures, I realize that when someone is doing a business, there was also an issue on governance, I think was raised in the earlier discussion, governance and transparency in terms of financial statements and documentation. And I think Keith made a comment that the accountants should be penalized for life. So as regulators, I'm wondering, what are you doing on the aspect of valuation? Because it is in the valuation space that if I put in money in a business, I expect a return. How is that business valued? And how are our stock exchanges operating in that space? If I put in my money, do I have a return? And the lady, I think was the MC, she talked about the investors in certain parts of Kampala. So how are you handling the valuation of investments that are supposed to be transparent, considering all these challenges? We've already noted that someone operating above the table is literally not going to make money, or the money he makes is not much. So kindly comment on that. Thank you.
Martin.
Keith has become a moderator to us. Well, Alfred, thanks for the question. Valuation. I think from our side, I said that our focus is risk management to protect and preserve members' funds. And in developing regulatory framework, we need to focus on those disclosure evaluation bit. I understand where you're coming from, the different costs that are embedded from the tax side, from the returns expectation, and the like. But this is where prudence comes in. Why would an imprudent investor come into a space that has all those litany of costs? So the issue is that if you want to sell the product to the person out there, what do you tell them? What kind of information are you tabling? If it's a valuation issue, what do you incorporate in the valuation? If it's a cost issue in terms of establishing the business, at the end of the day, what are the taxes that are applicable in the country for that particular product, and subsequently look at the return. If the two don't add up, and then why would I even invest into it? The discussion then begin, how do we support these initiatives through tax waivers, if any? Number two, if it's an issue of you need to invest into it, how do you look at the long-term package to recover the investment? I look at it from the short-term end. Again, how do you package all this information in the structure that you are going to sell to that person out to that? It's more of a being systematic and structuring it and disclosure. But it's a bit complicated because we've not yet come up with a regulatory framework, and that's what we aspire to do. Thank you.
So we have been, and we are still a disclosure-based regulator. We have been expecting that issuers disclose as much as possible about their finances, their forecasts, 1 year, their history, their business. And we have always hoped that the more disclosures are made, the more a market can understand value. And that's why we're partnering with people like the CFA, because we expect that when there's a public offer, the people we license, many of who are CFAs, will be able to weigh in on the issue of valuation, because the public relies on expert opinions on valuations before they make an investment decision. Now, I know that the reality has panned out a little bit differently, and I won't mention specific names, where it was mentioned by the first panel that in the IPO the prices go down, but that's really an indictment on the people who we license. And that's why I was very careful in my remarks that we need to strengthen the capacity of intermediaries, because we rely on these intermediaries. And indeed, if an intermediary consistently advises you to invest in something that doesn't turn out well, then the laws of competition should kick in, right? You deal with those whose opinion you want to rely on more in future. So I think there's a limit to how much regulation can legislate on things like valuation, is really the point I'm trying to make, and sometimes we just have to leave it to the market and the players in the market to determine what is the best value.
Good. Thanks, both Keith and Martin. I'm going to beg that there's one more question seems to be burning behind there. Can we take it and then sorry.
Hi, good afternoon. My question is to Martin. The pension schemes and funds in the room, in terms of where their portfolio has lied, has mainly been in the treasuries and bonds markets. But a lot of their membership, when you look at the last statistics, I think 720,000 are under the payee. But some of those are coming to their retirement age, and they will need to have payments that will be made out regularly. And so there's not enough incoming members to be able to then say, all right, we'll take a risk on one of David's funds that are 10 years from now. Unlike European and US ones, is there any support being given to them to take these investments into alternative, into PE funds, and is there anything being done to support them, would be my question.
What we don't want to dictate when a person is retiring is where they're going to put their money. But in terms of availing the liquidity for them at that stage when they're exiting, is it there? I think, like I said earlier, there is no serious liquidity issues in this market. And besides, there's a clear framework of managing the cash flows of any scheme in terms of knowing, because retirement age is normally given and known, so there wouldn't be any problem when to pay or how much to pay. I think the issue you're looking at more is how do you help that person out there instead of being paid the entire amount of money? It's invested in vehicles that can preserve that investment. For now, I think the policy that we're trying to push more on, there are two. Number one, can we have a framework that can support benefit payments? The pension model that we're talking about. And the second one, the products that are available today, the program withdraw or that distribute the payments, that's another vehicle. The one on the pension is a legal framework that we need to work on. The second one is more on supporting those who are providing options in this market for the accumulation of benefits. Where are they investing the money? I think a majority of them are investing it in collective investment schemes, which is pretty okay. About guiding them to invest in private equity, yes. What we want to avoid is the person, individual, who is not competent enough to make financial decisions without making use of professionals. So we want to really discourage that. And how the scheme support the people who are retiring to journey into another dispensation. That is something that we're also building on to help them know how to transit their money from the lump sum side and any other vehicle or even investment options. So there's really work to do for all of us. As your members in the scheme get to that exit, there's liquidity. How do you help them to manage it until they retire decently? Not only, but also have that continuous cash flow is the permutation and combination that we need to do to fill that space. It's homework for us. Political support and you people to understand that lump sum payment is not the best option for all of us. Thank you.
Good. Thanks, Martin. And with that, I would beg that we close this session now. And if I can request a big loud clap for my panelists, because regulators have to be careful for everything they say, especially to audiences like yourselves. Thank you very much.
Another round of applause for the panel. There was a very good thread that was weaved by the PSST and the panel. I hope you caught it. Keith said agriculture is a human right, and Martin spoke about a lack of sufficient products to invest in. He says the savings are there, the products are probably not enough. And the PSST spoke about a very interesting development that's in the pipeline. You would be interested to know that Nambole was constructed using, was it maize exchanges with China? And now we're speaking about coffee. And this could be the beginning of a solid futures market in Uganda. Maybe we could use the commodities exchange, design some futures and have those as another product to invest in and have these as G2G, transactions through coffee. It's an interesting dialogue to have and one that you will have time to chip in very soon. Right now, we would like to have the video. We have a very short sponsors video for the next minute, please. Oh, thank you very much, Girl Power. They say one image is worth 1,000 words, and I guess we had about 1 million words in there. But in short, they're supporting girls in coding and other things. Hopefully we can design some instruments for them to keep doing what they're doing. We are into the time for our next presentation. We have the presenter already here with us. It's a very interesting presentation which will answer some of Martin's concerns about the absence of sufficient products. We have a very experienced individual in the line of securitization. He's going to share some of the intricacies, and I hope you can be around for that session. At this moment in time, allow me to invite you for a coffee break. It's going to be a working one, so if you will, we've cleared your tables to create enough space for you to bring an additional cup of coffee to just boost your sugar levels as we get into a very insightful presentation that's coming next. So let's break off for 5 or maybe 2 minutes, grab a coffee, and return. And our next presentation is going to start in 3 minutes. Thank you very much.
Protecting your money is as important as earning it. It is for this reason that the Deposit Protection Fund of Uganda, DPF, was established by the government of Uganda to provide deposit protection to customers of regulated financial institutions. In the unlikely event that your commercial bank, credit institution or microfinance deposit-taking institution fails, the DPF will pay you up to 10 million Uganda shillings. Keep your personal information such as national identification number, mobile phone, or an alternative bank account updated with your banker. Terms and conditions apply. For more information, contact DPF at Aha Towers, Plot 7 Lodell Road, Kampala. Call 0312 206 400 or visit our website at www.dpf.or.ug.
We protect your money. Protection Fund of Uganda.
Protecting your money is as important as earning it. It is for this reason that the Deposit Protection Fund of Uganda, DPF, was established by the government of Uganda to provide deposit protection to customers of regulated financial institutions. In the unlikely event that your commercial bank, credit institution or microfinance deposit-taking institution fails, the DPF will pay you up to 10 million Uganda shillings. Keep your personal information such as national identification number, mobile phone or an alternative bank account updated with your banker. Terms and conditions apply. For more information, contact DPF at Aha Towers, Plot 7 Lodell Road, Kampala. Call 0312-206-400 or visit our website at www.dpf.or.ug.
We protect your money. Protection Fund of Uganda.
Good afternoon, members. We are starting in 2 minutes. If you can grab a cup of tea and take your seats, please. Albert. Can we grab our teas and take our seats, members? Members in the hall, let's grab our cups of tea and take our seats so that we can start on time. Thank you.
your money.
Protecting your money is as important as earning it. It is for this reason that the Deposit Protection Fund of Uganda, DPF, was established by the government of Uganda to provide deposit protection to customers of regulated financial institutions. In the unlikely event that your commercial bank, credit institution, or microfinance deposit-taking institution fails, the DPF will pay you up to 10 million Uganda shillings. Keep your personal information such as national identification number, mobile phone, or an alternative bank account updated with your banker. Terms and conditions apply. For more information, contact DPF at Aha Towers, Plot 7 Lodell Road, Kampala. Call 0312-206 400 or visit our website at www.dpf.or.ug.
We protect your money. Protection Fund of Uganda.
Ladies and gentlemen, take your seats. We are ready to start. Please. Mr. Alan Lwetabe, we are ready to start. Please. Who else can I see? Jato and team, we are ready to start. Please take your seats. No, we are starting. Please take your seats. No, just. All right, good afternoon, members. Once again, we are going to our next session. That is session 3. And before we dive into this next session, allow me recognize our event partners. A few of them will keep doing this during the course of our presentations. Gen Africa Asset Managers, BDO, Uganda Securities Exchange, Open Capital. Alan spoke about FITSPA, and a few of our sponsors, the Deposit Protection Fund of Uganda, Uganda Retirement Benefits Regulatory Authority, Deal Flow Facility, UAP, Old Mutual, and the European Union. Thank you. We appreciate the partnership during the organization of this event. Thank you. Our next session is on structured financial products. I'm sure most of us are wondering what the process entails. So to a layman's understanding, you would expect in a typical scenario of a bank, for example, that when you go to borrow from a commercial bank, the bank gives you money, you give securities to the bank. In this case, we are saying that the bad debt or the non-performing loans are transferred to a specific company. I'm just imagining. We have a professional expert who will come and guide us into this process. And this company does the restructuring and makes the securities sellable. And then me and you become the potential buyers into this security. So ladies and gentlemen, from a layman's perspective, could I have your attention, please? Thank you. So, to a layman's understanding, we are here to present you an opportunity that you can actually invest in a bad debt or a non-performing loan. Very interesting. I'm very intrigued to hear from Mr. Joshua Ogwal. Mr. Joshua Ogwal is a joint managing director at CLB Capital and the Asset Reconstruction Company, what we call ARC. He's also a leading lawyer in Uganda with significant experience in the financial sector. Mr. Joshua Ogwal has also worked in the financial sector at DFCU, UDB, and different institutions, and has headed financial or corporate law or mergers at different levels within the financial sector. Please join me in welcoming Joshua Ogwal to take us through the next interesting discussion. Thank you.
Thank you, Lisa. I was given a very difficult task of walking you through the securitization process and what securitization really is in a very short period of time. But I wanted, obviously being a Ugandan, Ugandans are by definition a bit of hustlers, and also being a lawyer, I wanted to keep it as relevant as possible. But I wanted to make it relevant to the extent that it also dovetails with what it is we are doing at the ARC. So what I'll do in this presentation is really just take you through an overview of what securitization is, the principles around it, and then we'll go into the approach that we are taking here in Uganda through the ARC and you know, how you can possibly partner in it. So securitization really is a conversion of financial assets into securities that can be purchased by investors. So you're basically passing off an asset that has cash flows, packaging it in a manner that a third party can buy it. That's essentially what securitization is. And there are different ways, different levels of complexity that can come into it. But essentially, that is what it is. A diagram that maybe brings it out and helps to describe it is what you see currently. The securitization is a lengthy transaction that begins with the entity. Now, in this case, we're talking of financial institutions. So an entity that holds assets, financial assets. And think of a financial asset as anything that has defined cash flows. So in this case, the financial institution is the one that begins with origination of the deal. They may have secured corporate loans, they may have
mortgage loans. Now, for as long as they have certainty with respect to the repayment of these loans, in other words, they are not completely delinquent, they can package these assets, pass it into a special purpose vehicle. Now, why do we keep talking about special purpose vehicle vis-a-vis securitized assets? This vehicle should do absolutely nothing other than hold the assets and issue the securities. Okay? It holds the assets for the purpose of ensuring that the assets are separate from the financial institution. It then issues securities to third parties, investors, who can then take benefit of the cash flows from those assets. Now, the reason this entity should do absolutely nothing other than holding the assets and issuing securities is that to the extent that it begins to get adventurous and do various activities, take up loans to go and enter into new businesses, any activity it does is adding onto the risk profile of those assets. Because if there is any failure in whatever business it undertakes, that failure will have an impact on the assets that it is issuing securities on the back of. So the fact that it remains distinct for the purpose of the securities is extremely important. Now, once it has packaged the assets, it then issues them to investors. Now, it can issue them in different tranches depending on the profile of investors it's dealing with. So if it's dealing with a single kind of investor that is happy to just take an equity position in those assets, then it will issue one single kind of security. And it can be either equity-based or debt-based. Equity means they take a position of ownership in the underlying assets. Debt, it would be backed. It would have a clear stream of cash flows, but backed by the assets. So depending on the profiles, the SPV sponsor can choose to create tranches. You can have a senior tranche for less adventurous investors who want to get some kind of credit enhancement, who want some level of protection. So that protection obviously comes at a price. They will get a lower return, lower risk, but lower return. Then you can have the mezzanine investors who will get a little more risk, but also a slightly higher return. And then the junior guys who are the more adventurous guys. Now, essentially the profile of each of these parties is determined by who gets paid first in the event that cash comes out of the SPV, and also who gets the hit first if there is any default on the packaged assets. So the junior, the guy at the bottom of the tranche, definitely feels the heat when something goes wrong. Why should we securitize? The first thing is transfer of risk. Banks, from time to time, underwrite assets that, because of their unique situation, they might not actually be capable of monitoring and managing the asset properly. There are several assets, particularly in highly adventurous fields, new fields, that are better managed by equity investors rather than debt investors. So securitization gives a financial institution the ability to actually transfer that risk to someone who can manage it better and profile it better. The second is raising funds. The principal source of financing for financial institutions is customer deposits. But customer deposits come at a heavy price. And banks many times cannot amass the quantity of customer deposits they need to write their products as quickly as the demand in the market requires. So what can they do? Package the assets they've already written, sell them off to investors through an SPV, get money from those investors as the purchase price for those assets, and then write new deals. It's an efficient process of raising capital on the back of the assets you already have, the cash flow you already have. The third is freeing up capital. Now, financial institutions are highly regulated. And the regulation is regulation that goes beyond just territorial regulation. It's all Basel-based. So for every asset that a financial institution writes, it has to set aside capital for that asset. Depending on the asset class, the more risky the asset, the more capital it sets aside. And now with the changes in accounting rules, as it writes out more assets and as it gets to perceive even the possibility of risk, it has to start provisioning. So over and above the standard Basel guidelines regarding how much capital it has to put aside per asset class, it also has to start writing on proactive provisions as and when it anticipates that there could be a risk on an asset. So securitizing the assets allows it to free up its capital, reduce its risk profile, and therefore reduce the pricing of its products and write new assets. Finally, from the investor perspective, I mean, in Uganda, our investments are really limited largely to the traditional types, government debt, bonds, treasury bills, or equities, which, as we all know in Uganda, are very illiquid. Beyond that, what else do we invest in? Land, maybe. There's not much diversity of products that we can invest in the Ugandan market. Securitization gives investors access to new asset classes with potentially higher returns. Now, to the extent that you're getting these assets from financial institutions, you have the advantage of knowing that these assets have been looked at by an individual bank which has underwritten them. So it's assessed a certain aspect of the risk, and it's packaged it well for you to receive the cash flows from. So there is that advantage to investors. So you get a new asset class and with potentially higher returns. What are the risks that investors have to deal with? Obviously, in this case, for securitization, where banks are choosing to pass on risk, the first risk that an investor has got to be prepared to manage is the credit risk. Now, that doesn't mean that you as individual investors are going to sit down and watch this portfolio of assets on a day-to-day basis, ensure that repayments are coming in. That's not really it. What it means is that you need to ensure that at the moment the assets are entering the SPV, they've been properly checked, the risks have been properly assessed, and you've taken the necessary steps to manage that risk. Now, one way that the risk can be managed is by getting some form of credit enhancement. And the credit enhancement can come in various forms. It can come in the form of insurance. It can come in the form of a DFI deciding to take an interest in the SPV and take a fast default tranche, so that if any defaults on the portfolio occurs, that DFI gets hammered fast. So there are various ways of managing this credit risk, but the key thing to take into account is the fact that at the time a decision is being made to invest, you as an investor has to check that the portfolio was properly, thoroughly analyzed by an appropriately rated agency or by an entity with credibility. And some audit firms in jurisdictions like ours, where credit rating agencies don't really operate, can actually do the job. The next risk is the liquidity risk. Now, whenever securitization has been done, essentially what you're doing is you're buying receivables. Receivables are based on contracts that assume that they will appear at a certain point in time. Now, for various reasons, that might not happen. But it might not happen because it's not necessarily because the credit has suddenly gone bad. It might not happen because of timing issues. Timing issues, a bank payment goes off late. It goes off late because there was a bank holiday in a particular jurisdiction when the payment was supposed to be made. Or, there was a sudden shock that hit the whole system, and we've all gone through COVID, so we know what shocks can be. They are not limited to the microeconomy of a particular institution. So a shock gets hammered, goes through the economy. The individual asset itself can make the payment, but it can't make it at that particular moment in time. So that is a liquidity risk. Now, the problem with allowing that risk to crystallize is that it then casts doubt on the credibility of the whole system, such that if the investor wants to subsequently sell the security, it will have difficulty doing that because that security would have been downgraded. So liquidity risk needs to be managed, and that normally is managed by some form of liquidity enhancement that comes through third-party institutions, who usually, it's effectively like a bridging loan. You're supposed to get a payment on the 30th of every month. They give you an assurance that on the 30th of every month, for as long as there is no change in the credibility of the underlying assets, they will make that payment available. So that is the next risk. The third risk is prepayment risk. Now that you may wonder, but prepayment is a good thing. It's a good thing generally for banks. It's not always a good thing depending on the kind of asset that you have been given. If it's an asset that has a fixed rate on the interest that it receives, there's always a risk that if prepayment comes in early, you'll have difficulty investing that money into another asset class that will receive the same type of cash flow stream, the same kind of return. And this is a risk because the reinvestment is essentially done by the SPV. So the SPV is not prepared, it's not structured generally to handle that risk. For that reason, there's normally an arrangement between the SPV and the financial institution to do asset replacements at points in time when those prepayments occur. The final risk is the operational risk. Now, the process that I described earlier was that assets are moved from the bank to the SPV, but the SPV does nothing. It just sits there, receives the assets, and issues them. If it does anything, there's a problem. So in order to ensure that it keeps the risk minimum, but ensures that the assets are being monitored and managed, it has to enter into an arrangement for servicing of those assets with the same financial institution. So that's called a servicer arrangement. Now, the ability to realize these cash flows still depends on the effectiveness of this financial institution in monitoring its loans. If there are challenges, because the financial institution may say, hey, I've already sold my full interest in these loans, why should I bother? The sales and credit guys are being paid on the basis of the number of loans, the quantity of loans they write in the new year. So the things they've sold that were written last year, hey, what the heck, forget about it. So that monitoring, that challenge that may arise if the loans are not monitored well can be a huge problem. Usually what will happen is that the sponsor and the SPV will agree to have a backup servicer in the event that that challenge arises. I'll go through the market drivers, in part because this also comes to what I'll talk about next regarding what we're doing in Uganda. But the market drivers are first and foremost the law, the concept of a true sale. There is, it may seem like this is a foregone conclusion. Assets are sold, obviously, the bank will not go back and try to get back these assets. But it needs to be clear at the time of the sale of the assets that, one, the bank actually had the right to pass off these assets and has passed its full interest in the assets. Two, that the assets are being passed off at a fair market value. Now, the two things are important. Because our sale of goods laws in most common law jurisdictions are somewhat interlinked with our laws on secured loans and secured instruments. There is always a chance that the manner in which the agreement is structured is such that it becomes a security rather than a true sale, and that becomes problematic. The second thing is that if the sale is done at an undervalue, then there's always a chance that later on, should any problem hit the bank, the insolvency agent of the bank will come and claw back the assets, and that's a problem. So essentially, those are two things that are looked at to ensure that this SPV is what we call bankruptcy remote. There should be no risk that should anything go bad with the institution, the bankruptcy agent or the insolvency administrator will come to the SPV to claw back on these assets. The other thing is that there should be an ability to assign receivables without the need for borrower consent. Now, this depends on the underlying contract that is entered in between the bank and the borrower. Fortunately, in Uganda, the standard bank contracts don't require borrower consent if they are assigned. They do require notification, but that requirement of notification does not hinder the assignment to take effect. So for now, in Uganda, that can be done. The third is the limitation of the SPV's ability to undertake transactions, and that I've already talked at length on. It should only be an SPV, nothing more, nothing less. You don't want to hear that the SPV that issued you securities is now entering into a fishing venture and has taken all its staff to the middle of Lake Victoria to do some fishing stuff. And finally, enforceability of the debt. Now, we've had some very interesting decisions in Uganda's banking space recently, which are very unfortunate. But essentially, there should be the ability of the courts to recognize the transfer of creditor rights from one party to another. That's an issue that has not been quite tested in Uganda's specific courts, but it's something which our creditor protection mechanisms in the courts give a certain level of confidence that this will occur. The next driver is transparency on asset quality. Now, I talked earlier on about how you ensure that you are ready as an investor to handle the credit risk. And really, it's about how the underlying loans, the underlying assets are cross-checked before they enter the SPV. And that's something which ordinarily is done by rating agencies. In developing jurisdictions like ours, we've got to be a little more proactive and think a little harder. So in our case, for instance, in the ARC, what we are doing is we're having discussions with particular audit firms to ensure that based on their credibility, they can look through assets before they move into the SPVs that we're looking at creating. So we've talked about how you manage the risk and how this drives investor ability to take on these assets. So liquidity enhancement, credit enhancement. Actually, in Uganda, under our laws, and that's the capital markets ABS regulations, if a sponsor has securities issued, they should ideally take up to 5% of the securities issued. Now that gives almost an automatic credit enhancement to any investor who takes up those securities. I'll now go to our specific situation in Uganda. And this is really around the asset focus that the ARC is on, and that's for distressed assets. Obviously, I will try to hide my smile, because I think some of you may be thinking, hey, you've talked about transferring assets, and now you're telling us that you're going to sell bad debt. What on earth are you trying to do? The reality is, when you look at Uganda's context and how our distressed debt gets distressed, you cease to look at it as bad debt. It really is more of underperforming financial assets rather than bad debt. And this is why. And I'll just go straight to it and then come back to this, to the earlier slide. There are three reasons for which debt gets distressed in Uganda. The first is, I'll just say, the aggressiveness of our entrepreneurs. We have excellent entrepreneurs. They're good at identifying the deals, finding the deals, transforming the deals into some kind of business, but they're not that good at creating the operating mechanism that ensures that they are continuously maintaining value and managing their risk. And that becomes problematic, particularly when shocks hit the company. And what we found is that usually when you can get into the company and begin to deal with these problems that, I mean, the absence of governance that guides decision making. And it's interesting how silly some of the decisions made are. I mean, there are instances where and this, by the way, is not just one. There are several instances we've come across where a borrower has taken money, short-term money from a bank, and has decided that suddenly he's hit a problem. There's another business deal that he's got to take advantage of. So he takes that money and then throws it into another business rather than using it for the purpose for which it was meant. The second business is good, but it was not the purpose for which the money was lent. So the governance around that decision was just completely non-existent. So governance is a major issue that causes default and distress. The second is capital structure, capital mix that many of these entities have. In Uganda, again, we really have three sources of funding for businesses. One is your personal savings, and we're not talking about NSSF here, your own personal savings. And if each of you took an honest moment to consider the savings you have today, that tells you how limited the depth of that source of capital is. The second is borrowings from family and friends. And woe to you if you lend money to your sibling, because you'll likely not get it back. The third source is bank debt. Now, the first two sources are sources which would potentially have been long-term, but we know they are not very deep. The third source is quite large. The problem is that by definition, that source is short-term. It's short-term in nature. Even when the banks say they're lending you for 7 years, really they're just rolling over a 1 year loan, and that's the reality. And if you look carefully at your contracts and consider the banking regulation, that's essentially what banks do. So what this causes is, for many companies that go into distress, there's really a mismatch. They borrow short-term for long-term investments. Long-term investments, whether it's setting up a manufacturing plant, it takes a while for the cash flows to achieve the level that they should achieve for the company to be able to pay comfortably. And that takes time. So the mismatch inevitably causes distress. Now, those two reasons account for 97% of the assets that we look at. 97%. So are our distressed debts really distressed? Those two reasons are reasons which are effectively restructurable. They are things which should have been taken into account at the onset of the business or at the time the business was making the capital raising decision. So that's why I said these assets are really underperforming rather than bad assets. The third reason is really, again, where the gap is and therefore where the opportunity for investment is. Banking regulation limits the ability of banks in Uganda, and I also believe across East Africa, to restructure the loans that they are managing. They can only restructure twice, and even then, there is no depth in the restructure. They only restructure the loan itself. They can't go down into the business and deal with the issue that caused the distress. So the distress is certainly bound to recur. Now you take all of those into account and you get an investable asset. Now, when we did a review with the Bankers Association, we found that these types of assets account for at least, the value of these assets are at least 1.5 billion in Uganda. You're talking of non-performing assets as well as written off assets. So, and many of those are assets that can actually be restructured. So the ARC was really created by the Bankers Association under the auspices of the central bank to deal with these assets, to work with the banks to take on these assets, manage them, restructure them, and the restructuring being dealing with the governance issues that I've talked about, working with them to raise capital, and then working with the banks to restructure the loans. But our mandate also covers purchasing these assets, and that's something that we're currently working on with a couple of consultants who we're raising capital through. I'll go into the process that we usually undertake when we are, let's say, sanitizing these assets. Obviously the first thing is getting an understanding of the assets, and that's something which banks are normally very sensitive of, because they don't want to pass on client information to third parties. So in order to be able to do this across banks, we had to get central bank approval for accessing of this information. We are able to build trust usually with the borrowers and begin to work with the borrowers on putting in place appropriate restructuring plans. Where the entity we're dealing with is one that is insolvent, there are particular mechanisms provided for under the law that allow you to reorganize a company under an insolvency scenario. Now, you can appoint a receiver, you can go into administration. The problem, though, is that many times when you go that route, the borrower at times will think that you're trying to fight them when you're not. I mean, there's one live case where we were working with a bank that actually wanted to restructure work with us to restructure a borrower's business. The bank realized that based on the history, it could not quite trust the people managing the business, but it recognized that the underlying business itself was potentially good and could help it recover its loan. If it sold the assets at that point in time, it would recover only about 40% of the loan. The problem was when the receivership was made, when the receiver was appointed, after obviously discussions that were had with the borrower and with the borrower's off-takers, the borrower went haywire and failed to cooperate with the bank. Now, because of that, we've been unable to restructure the asset as we had wanted to, and the opportunity to get an underperforming asset back to health has definitely been lost, because the goodwill from the bank has gone through the roof. So there is that challenge when you go down the insolvency route. It's much easier, obviously, if you're dealing with a fairly solvent company, because with a solvency scenario, you can always enter into deeds of settlement with the borrower, build trust, implement the restructuring arrangements that you agree upon with the borrower. And many times, the borrowers in that scenario are willing to listen, willing to work with you. The advantage is that they are looking at the ARC rather than the bank. So you're considered a good friend with a solution. And we've been able to make significant progress with borrowers we're dealing with in that scenario. Now this graphic really just guides you through our process in creating value. The value creation usually starts at the point of discovery of the facts regarding the assets. So thorough due diligence, ascertaining the credibility of the borrower, the integrity of the borrower, and whether this is someone you can work with, getting the facts regarding the underlying business, and getting the buy-in from the bank. It's also at this point in time that we can then begin to price the asset, because at this point we are able to tell whether we can actually come up with an appropriate restructuring plan for this asset. We are able to make a determination as to the chances that exist for this asset to actually be turned around and the value that will increase as a result of that. Or if this is an asset that you're really just going to break up and sell, and you price appropriately when you're looking at buying the asset from the bank. The approach that we've taken at the ARC is we usually take these assets initially on a management basis to allow us adequate time to really understand these assets. It's only after we've fully understood the assets and we've worked with the borrower with the bank to an extent that the bank is able to take a fair view also of the pricing of the asset. It's only at that point that we begin to work with investors on potentially buying the assets. So we've got the value creation aspect of the business. We've got the asset management, which is now implementing the restructuring plan and then monitoring to ensure that the entity is actually returning to health. And finally, offloading the asset back into the financial sector. I say that with a half smile, but yes, indeed, back to the financial sector. So that really is what we are doing and how we do it at the ARC. I hope I have not scared you guys talking about distressed debt. I think we'll agree to call them underperforming debt. But essentially, securitization, even at this level that we are looking at doing it, is really something that is good for the markets. It's creating new products for the markets with higher returns. It's deepening the assets by pulling more capital into the markets for businesses, and not just more capital, appropriate capital, long-term capital, patient capital. The reality is that although we've got, the pension funds, and I'm sure some of them are here, the pension funds many times have not been able to find the right channels to pass money directly into business. This is an opportunity for the pension funds to consider. Finally, it will reduce risk in the financial sector. By doing what we're doing, we're trying to get the banking sector to move risk in its portfolio out of its hands into the hands of those who can manage it better. I will stop there. Thank you.
Thank you. Ladies and gentlemen, a huge hand clap for Mr. Joshua. Thank you. You can take your seat as we wait for questions. Earlier, during our discussions, my good friend Zach was very disturbed, sorry to use that word, but he was very passionate on behalf of fund managers in this country, how much they yearn for diversification opportunities. We promised you at the beginning of the session, by the end of tomorrow, we will have provided every solution. There is a solution in SPVs. So we are happy that so far we are the link between the likes of Zach and Joshua here. So a round of applause for ourselves. Thank you. At this point, I would like to recognize a special recognition for our members who have come in from Rwanda, Kenya. We have David. David, the other name I'll try, but if it's not accurate, we'll work with the one I've pronounced. So there is David Mwahura, CFA, and we have Makopa. The other one I'll not attempt, but Makopa is one of our oldest charter holder. It's a privilege to have you here now and also later during the Charter Award session. Thank you. Let's give a round of applause. We have some members from Rwanda. Thank you for joining us in this inaugural Alternatives Investment Conference. So at this point, we'll take questions. But before, I just wanted to ask Joshua, do you mind sharing some practical examples of the companies or how much you've been able to structure or restructure, for example, the clients that you're working with so far. I think it will give us a more practical concept, again, for my friend Zach, so that he can have comfort that there are people who are doing these things. Yeah, so thank you.
Okay, now obviously I will not mention names because I will get into trouble. But at the moment we are dealing with two financial institutions whose assets we are managing, whose bad debts we are managing and restructuring. The total value, because we are practical, we are not looking at biting off more than we can chew. So following some reviews and technical assistance we got from the IFC, we decided to take a fairly slow approach of commencing the business fast, building the right structures to get these assets turned around, and then going into the market to raise capital. So at the moment we're holding a total of about $70 million worth of assets under managing the assets from these two institutions. There's the opportunity to increase that, and we expect that will grow in the course of the year. We have, because of the approach that we are taking, which is kind of a slow approach, we have not been aggressive in building the portfolio that we're managing. We are currently, the $70 million is spread across about 13 different assets. So we are at the tail end of exiting about 3 of them at this point. I took you through one of the diagrams, I took you through one of the graphics, I took you through, really gave the gestation period from the point we commence to the point we exit. And that's really the gestation period we look at, which is really about 24 months. This initiative is not meant to be a long-term business. It's meant to be very short-term. The ARC doesn't aim at competing with financial institutions. We manage a very specific type of asset class, and that asset class can be restructured within a very specific period. And the period we're really looking at is 24 months. At times it can go a little beyond to maybe around 36 months, but really that is the period. And once the company has been nursed to health, then it's not our business to be dealing with it. It's the business of either the banks or other types of investors. So that really is it.
Thank you so much, Joshua. Any other question?
Thank you very much, Mr. Joshua Gwal, for your presentation. I think it was quite informative and educative for me. Now, I have a question, and Lisa seems to have preempted my question, because my question was, realistically, when do you see the asset reconstruction company securitizing and bringing securities to the market? You actually projected the Capital Markets Authority asset-backed securities regulations, which are quite appropriate, receivables, cash flows, SPV, you name it. So when do you think realistically could come to the market? Then the other question I have is on the Bank of Uganda regulations and securitization. I mean, how do the two dovetail? Okay. What's the nexus here, so that you don't end up running afoul of the regulatory framework? Right, thank you.
Thanks. Those are very good questions. When do we look at doing securitization into the capital markets? At the moment, what we're doing is we are working with specific institutions and creating SPVs for specific assets that we're looking at passing off to them. So at this point in time, it's kind of a fast level of debt sale. What we anticipate is once these transactions are complete into that fast vehicle, and the investor is happy with the cash flows and wants to, make his return quickly, he can at that point then pass it on to the second level of investor. And that would now be the full securitization that you're talking about. But to the extent that these assets will be leaving the bank's balance sheet, because that will, once we move it to the new SPV, it's actually moving out of the bank's balance sheet. And that would not be a complex process where we sit, because as it is, we're dealing with assets that we are already managing. So it's really converting an asset from something you're managing for a bank to something that you are managing for someone else under a different vehicle. So that's essentially what is happening. Regarding the regulatory issues, and again, that's a very interesting and relevant question. The Bank of Uganda went through quite a process in determining how it was going to regulate the ARC. At some point, they came up with the suggestion of creating a whole new law for the ARC. But that was found to be inappropriate for the reason that it takes a very long time for a law to be put in place, and the market does not sit and wait. Also, the problem with a statute or even a statutory instrument under the Financial Institutions Act, which is another option they had, was that it sets in place certain strictures that then become hard to change. And they felt that this was improper in a scenario where you're just trying to grow a market. So what they decided to do under the BOU Act, the Bank of Uganda can create participation agreements. So they decided that they would create participation agreements through us so that every entity that is within the financial sector that is looking at selling its assets in any manner should come under that participatory regime. And obviously the key participation agreement was between us as the ARC and them, and then the other entities join. Now that from my perspective was truly it was innovative for the central bank. Central bankers normally think in a very closed manner. So the fact that they could think with such flexibility and such sensitivity to the need to grow the market was truly something we found impressive. Now, considering that against CMA regulation, the CMA regulation obviously will kick in once we go to the second level of securitization. For now, we are happy to deal with the specific investors on specific SPVs for, again, the specific assets that they want to take on. So that really is it. I hope it's answered your question. Thanks.
Thank you very much. Just a few comments. Thank you, Joshua, for the good marketing of the securitization or what you are doing. Thank you. I have a few questions and comments. One, from your explanation, I think securitization is much bigger than what ARC is doing. So my question and concern with the way you are working with the BOU and the banks, are there possibilities that there will be a process of securitizing good debt, good securities, not the distressed securities? Because currently you are dealing with distressed securities, and the $70 million you've talked about compared to the 1.5 billion of the distressed debt is actually less than 5%. So on top of that, where is the 90%, 95% of the distressed debt, where is it sitting? And then you are concentrating on the 5%. My second question is, together with BOU, the Uganda Bankers Association, and all the banks, they know that most of the lending in the Ugandan market is actually short-term lending. There is a mismatch between the lending duration and the assets they are lending. So right from when they are beginning to lend, they already know that. So their efforts together with this to improve provide more long-term lending, because we all know that long-term lending doesn't exist in Uganda, or it is very rare. Someone mentioned, she asked about the numbers. It would be good if in the future you can share with us more numbers in terms of how many companies and that you have supported, and how many have come out of that, because we need to know when someone goes into ICU, how many of them are coming out and how many are not coming out. Can you also make a comment on the valuation of these assets that you are dealing with? Because if we are to invest, we would need to know, at least to have a framework of how you are dealing with the valuation. Thank you very much.
Okay, I'll ask you, sorry, I wasn't writing down, but I'll just, if I miss out something, you will tell me. And again, those are very good questions. The first was around when will good debt be, securitized? In the discussions that we had with the central bank, one of the concerns that the central bank had at the time we were having engagements with them was the extent to which we could take on assets from banks. At what point of distress should we take on assets? Should we take on assets that are on watch? Should we take on assets that have gone beyond watch and are now proper NPL? Should we take on only written off assets or fully provided assets? One of the concerns that the central bank had was that if they allowed the banks to immediately hive off assets that they've just written, it might create a moral hazard issue. And this is a time the bank had just come out of the crisis with Crane Bank. So one can understand why the central bank had those concerns. And those are concerns which I think are still lingering in their minds. And obviously it will take a while as they see that NPLs are being properly resolved, are being properly converted, and are being returned to health. And if they see us moving further and further up the scale of non-performing, from watch to the second level to substandard, that will then give them more confidence to say, okay, fine, we're happy to see a lot more securitization of good debt, so to speak. That is my sense regarding the reasoning that they were giving at that point in time, and one can understand where it was coming from. Regarding the issue of valuation, the first time we engaged the banks, and it's a very interesting thing, the first time we engaged the banks on an offer to purchase, to take on assets of a particular bank, where an investor we're working with was looking at actually taking on the whole NPL portfolio. We started having a discussion with that particular bank. I think it was towards the end of 2019, December 2019. By September 2020, there was no agreement on price. Now, the reality is that with a novel market on securitization, or a novel market on any debt sale, there's always going to be an issue of what is the price of this asset. Banks are, by their very nature, greedy. I say that because I've worked in a bank before. Banks are greedy. Banks will not want to give away any value if there is a chance that they may capture that value somewhere down the line. So pricing became an issue, and that's part of the reason we decided to change our approach and begin with fast managing. It's only after we were able to take on assets for money under management, and the banks were able to work with us and the borrower on restructuring these assets. It's only at that point that they got a sense that, hey, this thing may take some time. It may take some time, there are serious issues that need to be resolved, and I am not in the best place to resolve it. It's only at that point that, you know, one of the banks that one of the entities we're dealing with is very willing to let go of some of the assets. So I think that explains, that gives a sense on the valuation. So from our side as the ARC, we would value an asset for what it's actually worth. So if it's a mongrel, we'll value it as a mongrel, not as an Alsatian, you know, to put it very bluntly. But the banks have got to be willing to do the same. So one, we had to take a moment and actually walk with the institutions we're working with, walk with them so that they get an understanding of the pricing. Obviously, as we do the initial transactions that we're currently looking at, you know, that will ease the pricing as we go, you know, transaction to transaction. But indeed, valuation and pricing is a major issue. Regarding the assets, I think I had indicated we've got a gestation period. Of the gestation period, about 13 assets we're dealing with, 3 are really on exit mode. We're dealing with investors and just waiting for that final investment decision. But all of this really occurs within that, you know, 24-month period. Some go over into 24 to 36 months. So that really is it. I hope, I feel that there's one I have not answered. The mismatch. At the time the assets are being written, there's a mismatch. Indeed. Now, unfortunately, that particular one is outside of my purview as the ARC. It's something that BOU is, you know, should be looking at. But the reality is that commercial banks really are essentially short-term vehicles. And that's what bank regulation has created. So that creates an opportunity. And it's not a, it's not a problem. It's not a problem. It's a good thing. It's a good thing for long-term investors. It's a good thing for pension funds. It's a good thing for PE firms, because then therein lies the opportunity for them. You know, whether working with particular banks or working with entities like ourselves, that's an opportunity for long-term investors.
Thank you, Joshua. Oh, we have a question. Okay, just one more question.
Thank you very much. Thank you, Joshua, for the insightful presentation. I just have 2 questions. One, we for a fact know that securitization was one of the major causes of the financial crisis that started in 2007. So I'm looking at what measures have you put in place that could curb such acts, because we're looking at the sector coming from, we're just recovering from COVID-19 and its effects. So now we're starting to go probably on an upward trend in the financial sector. So what measures have you put in place so that Uganda as a nation, the financial sector stability is not affected by this product? Then the second question is regarding the scope, because in your submissions, I keep hearing commercial banking. So are we looking at other tiers? Are we looking, are you concentrating on only tier 1, or you're going down to tier 2, tier 3, and tier 4 of the financial sector? Thank you very much.
Thanks for that question. I'll begin with the second question. We are currently focusing on the banks at the moment, because that is where the largest impact is. So that's a quick question, but that's not where we will end. Our mandate is to begin with the banks and then go down the line as it's justified. But we also are sensitive to the issue of risk. So we are dealing with credit that first and foremost is secured, so that there's obviously less risk to the investors that are taking it on, and there's the capacity to recover at least the investment. And we found that it is at least at the beginning, at the commencement phase, it's easier to deal with the larger assets, both from an impact perspective and from the perspective that you are still having to use the very same tools. It generally is easier to restructure, slightly larger assets. So that's where we started, but certainly not where we're ending. Regarding 2008, now the issue with the 2008 crisis was really a mix of, very low or almost negligible regulation around the assets themselves, very little transparency around the assets again, and then, just outright greed. Guys were focusing on, the immediate gains from writing these securitized assets rather than what would happen down the line. And in any case, these were obviously already subprime, so they were terribly messed up assets from borrowers who didn't have the capacity at all to pay. What we're doing in this case is, first and foremost, to ensure that we limit the extent to which any risk can pass. We're beginning with the first level, deal with particular financial investors who are willing to invest in packaged assets under an SPV. So it's not going to immediately go into the market. Secondly, this is being regulated by Bank of Uganda. So essentially, even before we've started going into the capital markets and going to the, passing off assets from the SPV to other third-party investors, the central bank is already looking at what it is we're doing and ensuring that, assets are being properly restructured. There is sufficient disclosure being made to them and reporting on everything that is happening. Thirdly, one of the things that we are also doing, and I mentioned it earlier in the presentation, is even passing these assets into the SPV. We are currently working with two audit firms of great repute to do reviews of these assets before they get passed, to give a certain sense of assurance regarding the state of the assets and the practicability of the restructuring plan and where we are on restructuring. So that's what's being done. Obviously, one can never be 100% in risk mitigation mechanisms, but at least you can take positive steps towards mitigating risk, and that's what it is we're doing.
Thank you, Joshua. Ladies and gentlemen, join me in thanking Joshua for a very insightful presentation. Another round, please. I know it's lunchtime. Let's keep the energy up. Thank you so much, Joshua. This has been a very insightful presentation and quite knowledgeable. Ladies and gentlemen, during lunchtime and during the course of the conference, you can reach out to Joshua and ask any other further questions and engage for any further clarifications or as a potential investor. It's 15 minutes to 2 o'clock and we shall be going for lunch. Lunch will be exactly 40 minutes. So we expect to be back at exactly 2, that is 2 what? 2:35, 2:40, let's say 2:40. No, let's come back at 2:25. I've been guided. So we'll be back at exactly 2:25 and start at exactly 2:30 for the next sessions. Lunch will be in Kazinga. You're most welcome for lunch and see you in the afternoon. Thank you. Ladies and gentlemen, kind reminder, keep your tags on. This will be your access cards for tomorrow. And yeah, so keep them on and keep them safe. Thank you.